There are moments in the market when price alone doesn't tell the full story. Welcome, traders, to Maximum Trading Gains with Anchored VWAP by Brian Shannon, and a strategic guide that reveals the true battlefield between buyers and sellers through the eyes of volume, price, and time. This isn't your average trading audiobook. This is a lens, a powerful lens, into how professionals anchor their trades, how institutions manage risk, and how the smart money stays a step ahead. Here are brief descriptions of chapters 1 through 5, the foundation of understanding, anchored VWAP, and the deep psychology that drives price. Chapter 1, VWAP and AVWAP. We begin with the evolution of VWAP. Traditional VWAP tracks intraday flow, but AVWAP anchors to events, giving us clarity on who holds power, buyers or sellers, from that moment forward. Key insight: AVWAP isn't just data, it's a memory. A record of conviction, a line in the sand that traders respect. Chapter 2, Price, Time, and Volume. Here, Brian teaches us that price is just the surface. Time and volume are the undercurrents, and together they paint a truer picture of strength and vulnerability in the market. Key insight: the market isn't random. Volume validates price, and time reveals intent. Chapter 3, Institutional Background and Algorithmic Trading. Now we go deep. The pros are using these tools. Funds, quants, and algos all operate with AVWAP baked into their execution logic. Knowing this puts you closer to their playbook. Key insight: when you trade with anchored VWAP, you're thinking like an institution, not a gambler. Chapter 4, Market Sentiment Tools, Psychology, and Anchoring. Markets are moved by emotion, fear, greed, and hope. Traders anchor to peaks, gaps, and news. AVWAP captures this behavior. It lets you see where pain exists and where opportunity lies. Key insight: AVWAP reveals the psychological gravity of a price level. Chapter 5, Anchored VWAP Components and Comparisons. Finally, we dissect how AVWAP compares to other tools, moving averages, indicators, overlays. But none offer the same surgical precision. This is where math meets intent. Key insight: anchored VWAP adapts, evolves, and tells a story with every candle. The bottom line: if you're tired of noisy signals and late indicators, AVWAP offers a clear view, a tactical edge, a weapon. Brian Shannon doesn't just teach you a tool, he trains your eyes to see what matters most in real-time trading, conviction, control, and consequence. Hit that like button, subscribe, and buckle up, because we're diving into the mind of the market, one anchored level at a time. Let's begin with Chapter 1, Maximum Focus, Maximum Clarity, Maximum Gains.
Maximum Trading Gains with Anchored VWAP. The Perfect Combination of Price, Time, and Volume by Brian Shannon. Preface: how I discovered and why I use the Anchored VWAP, AVWAP. I wrote this book to introduce the anchored volume weighted average price of VWAP to new users. For those who are familiar with it, this book will advance new concepts and strategies to help you become more profitable. Before you dive in, I thought you'd be interested in how I became an expert on this important tool. Here's my origin story. In the late 70s, when I was about 10 or 11 years old, I had a clue that I would do something in the stock market as a career. My father was a doctor, and when he wasn't on call, we watched Wall Dollar Treat Week with Louis Rukeyser on PBS. It's on Bloomberg now, but it started out on Maryland Public TV. I was a teenager when LoJack made local news for giving Boston police transponders to help with the skyrocketing rate of auto thefts in the city. With a few years of WWW under my belt, I had the bright idea to take all the money I'd earned caddying and delivering newspapers and buy some LoJack stock. At the time, it was trading at $5 per share, and my dad agreed to go in with me. I turned over my $500 and he bought 1,000 shares. Yes, you're right. He gave me 101 leverage, and I didn't even realize it at the time. The shares doubled in about 3 months. From that point on, I wanted to be a stockbroker, not because I wanted to sell stocks, but because that's the only job description I'd heard for someone who works with stocks and bonds. After studying business management in college, I started at a firm that is best described as a boiler room operation. The lines out of the Ben Affleck movie Boiler Room were basically our sales pitches, but I didn't want to be in sales. I wanted to buy and sell stocks. Like most brokers learning the ropes, I moved from firm to firm. No one was teaching technical analysis, they just told you what they wanted you to sell. While I was working at Lehman Brothers, the best producer in my office used the strategy of buying companies that recorded positive earnings surprises and used charts to back them up. That's where I learned to be a salesman, which is an important life skill, but again, not what I wanted to do all day. I'd been reading Investor's Business Daily, which had some charts, but I'd still never even heard of the concepts of either AVWAP or the very closely related volume weighted average price, VWAP. Denver lured me from the East Coast in 1991, and I had learned about technical analysis and started trading online with a 24K dial-up modem. During the years between 1995 and 1998, I taught a class for the guys in my office on my own methods of technical analysis, even though I still hadn't been exposed to VWAP. One day I saw an ad, "Trade with our capital." 201 leverage, which intrigued me. I kid you not, the advertiser's name was generic, trading out of New York. They said to trade their funds you had to have $25,000 and be a registered broker. In 1993, when I was only 23-24, living in a little house with my wife and a new baby. I didn't have much, but I had my broker's license, so I scraped the money together and quit my job. It was a completely foolish decision, but it was also the best decision because it worked out. I controlled $500,000 in buying power as a trader. The firm gave me almost no support other than a basic quote package. There must have been charts, but I can't remember them. They would have been basic. They took 10% of my profits and part of my commissions. Our idea of support was, here's how well you did and here's your check. You might not believe that a young man didn't take big advantage of the leverage, but I couldn't afford to lose money. My $25,000 was really just a stop loss for my firm, not something I was prepared to lose. I made money every month using a strong risk management philosophy that sticks with me to this day. I don't chase things. Risk management is job number one as a trader. In 2002, I left generic trading and worked for MarketWise Securities in Colorado, where I taught technical analysis and trading classes and headed up the proprietary trading department. MarketWise is where I started using real tick software and saw VWAP for the first time. At that time, I saw it as a trendline tool. Most software charts allowed you to draw a straight horizontal or vertical line. This software had an option to see a VWAP line. Instead of going horizontal, it would follow the price up or down and then hit a point and bounce. What is that bounce? I figured out that it was the average price and concluded that something's here that makes people buy or sell at the VWAP level. I knew it was a measure of market psychology and supply and demand. Real Tick displayed a VWAP for only one day, and I found a way to get a 5-day VWAP out of it. I couldn't anchor to the middle of the day or anything else, but started noticing that it was useful anyway. For a long while I would anticipate with it, use it as an extra piece of information to build my confidence on a trade I was already looking at. It wasn't my primary tool then, but was becoming more important. I wanted to know more, like what if I could look at a chart with a VWAP for more than 5 days? What about tracking at the start of when a company reported earnings 13 days ago? The tool wasn't designed to do that, so I hacked it to see the VWAP that way. I didn't realize why it was important, but knew that it was. That's when I started wondering how I could view VWAP similar to a moving average instead of just a horizontal line. I wrote my first article about it in 2005, Chase the Gap or Wait for VWAP. I continued to track and use the VWAP as I moved on to other business ventures, including running a day trading office. In 2015, when Michael Thompson from the trading platform TC2000 asked me to use their software for teaching my technical analysis classes and in my training videos, I said, if you can create a point-and-click volume weighted average price tool for me that allows me to set multiple starting points and move them around, I'll use your software. A couple of months later, they did. TC2000 called this new feature Anchored VWAP by AlphaTrends. Others developed their own versions of the same software features and came up with their own names. I've listed some of these in Appendix C, sources for Anchored VWAP on charts. Introduction: How to use this book. My goal for this book is to give you a thorough understanding of the VWAP and the AVWAP so you can learn how to interpret market action more accurately. This knowledge will allow you to make better trades. The typical technical analysis tools to look at on charts are moving averages, moving average convergence, divergence, MACD, relative strength, etc. They're all part of the universal curiosity people have for trying to crack the secrets of the market. After 3 decades, I realized that simplicity is the market's greatest disguise. Simple works. I focus on the current price, the price's behavior over a few different time frames, a couple of moving averages over different time frames, the volume, and the AVWAP. The beauty of the AVWAP is it represents the absolute truth of the relationship between a stock's supply and demand, and it is a 100% objective tool. It may be too obvious to repeat here, but the interaction between supply and demand is the primary determinant of price, and the AVWAP is the best tool to show us supply and demand. This book has 3 sections. Part 1, Foundations of VWAP AVWAP. It will benefit both novice and veteran traders to start here. This material is the foundation for understanding VWAP and AVWAP. You may be familiar with a lot of the terms and concepts presented, but they have never been presented in AVWAP analysis. It covers the components of VWAP and AVWAP, how and why institutions use it, how it is calculated, and the psychology of it. This is a fresh approach. The material laid out here is the foundation for the strategy-heavy Part 2. Part 2, using AVWAP. This is the strategy section of the book. It is packed with charts and detailed strategies you can use in the markets every day. You will learn how price changes in public markets so you can find the highest probability, lowest risk trade ideas suited to your personality, time frame, and objectives. We will study examples of a VWAP where it was a definitive signal to act, and also study examples where it provided no value. Nothing works all the time in the markets. Therefore, I emphasize risk management in every example. I want this book to help you to better understand supply and demand in the markets so you can make more money. There is nothing more accurate than the AVWAP to guide our analysis objectively. These are the same strategies I use in my daily trading. Part 3. Appendices. Newer traders who may not be familiar with the foundations of technical analysis will benefit the most from this section. They might even want to read this first to see how the information in the rest of the book fits with concepts I have written about over the last 3 decades. These are primers on market structure and the understanding market structure chart, including the market stages of accumulation, markup, distribution and decline, moving averages, trend alignment, and more. You will also find some reference materials to download and software providers of a VWAP. I geared most of the material towards swing trading. Swing traders hold a stock from a few days up to a couple of months. Swing traders attempt to have their money in stocks that are in a longer-term trend, whether higher or lower. When momentum wanes, it is time to harvest profits. Their goal is to leverage time and capital by being involved in the primary trend moves and to avoid the natural trend corrections. When done properly, swing trading attains the goals of steady growth of capital and avoids large losses. It is up to you whether you want to use technical analysis as a standalone tool, combine it with fundamental analysis, or use other methods of trading and investing. I'm not here to convince anyone what to do with their money, only to provide a comprehensive overview of the technical tool which has given me the best results. I have written this book in a way that is easy to understand, and I am convinced that you will choose to make the AVWAP part of your arsenal. Part 1. Foundations. Chapter 1. VWAP and AVWAP. If you have knowledge, let others light their candle in it. Margaret Fuller. Chapter Objectives. 1. Understand the difference between VWAP and AVWAP. 2. Understand how the VWAP and AVWAP are constructed. 3. Understand applications of the VWAP and AVWAP. 4. Learn how VWAP and AVWAP became analysis tools. Technical analysis indicators are timing tools, of which the VWAP and AVWAP are 2. They were created to help us identify the right stocks at the right time and at the right price for trading success. Over my 30-plus years of trading, I have studied all the popular technical analysis tools at some point, everything from MACD, RSI, stochastics, kurtosis, Gann, Elliott wave, and more. A lot of them were helpful, but I couldn't find true consistency in their interpretation. My deep understanding of supply and demand in the market came about in 2003 when I first encountered the VWAP. This book focuses on the VWAP, and even more so, the AVWAP. Components of the VWAP and AVWAP, price, time, and volume, our study of market action with AVWAP, will begin with a study of the 3 most important variables in auction markets. Those are price, time, and volume, and they are the components which build the AVWAP. Price is how we keep score. It is how we determine success or failure. There is nothing subjective about its measurement. Time is a constant. We cannot change or manipulate it. Time is how we organize market data, and it becomes the most subjective component when you decide where to anchor your VWAP starting point. Volume is a variable that is affected by the decisions of all market participants to buy, sell, or stand aside. At any specific price point, or within a price range, the number of buyers and sellers varies depending upon a number of factors. You will learn about these factors in this book. The study of these market components allows us to glean greater insight into who has control of price action, buyers or sellers, and how committed they are to their respective intentions. Together, price, time, and volume help us to execute more profitable trades. Volume weighted average price, VWAP. The volume-weighted average price, VWAP, is the cumulative average price of a stock traded during one day. The calculation of the VWAP begins the moment the market opens, builds throughout the day, and concludes at the close of the session. For equities, users can choose whether to use pre/post-market hours in the calculation. The daily VWAP resets at the start of each new day. Because price is weighted by volume, not time, the VWAP is the true dollar average for the time period studied. Each share traded by retail and institutional traders, long and short, receives equal weight in the calculation. The VWAP is more responsive to volume trends than price action because of its volume weighting feature. Accordingly, as volume levels change pace of trade throughout the day, heavier volume periods have more impact on the movement of the VWAP, while lighter volume periods have less impact on the movement of the VWAP. The VWAP is a straightforward study. There are no settings, adjustments, or offsets to complicate its measurement. Anchored volume weighted average price AVWAP. The AVWAP is the same as the VWAP except that the starting point, the anchor for the volume weighted average price calculation, is set by the user at a specific meaningful point. That is, it is not simply the start of the trading day. When we start the VWAP calculation at a point other than the start of the current day, it becomes anchored to that first point, and we call it an AVWAP. The AVWAP allows us to measure VWAP from any point, on any time frame, for any interval. The trader chooses a starting point at which to anchor the VWAP, and once the starting point is so anchored, then from that point forward, the AVWAP calculates the cumulative price and volume of each transaction, the result being elegantly displayed like a moving average along with price. As you will learn, the anchor point is the most subjective part of our analysis. We will explore many valid anchor points to begin our analysis, and why we anchor at those points. The AVWAP broadcasts the message of the market, that is whether sellers or buyers are driving the then current price trend, more clearly than any other technical tool I have studied in my 30-plus year obsession with the stock market. The book explains in detail the AVWAP, its components, calculation, how to choose the anchor point, AVWAP strategies, and how you can use it to increase your profitability. There are two VWAP lines in chart 1.1. The first one, light blue, is anchored to a large price movement event. Because it starts at a point other than the beginning of a new day, it is an AVWAP. The second one, dark blue, begins with the new day. This is the traditional VWAP calculation, how VWAP and AVWAP became analysis tools. VWAP and AVWAP have morphed from benchmarks of execution measurement into technical tools that are used by market participants in all time frames to assist in trend recognition and timing of buy and sell decisions. I first noticed a VWAP on the trade platform RealTick in 2003. At that time, the only way to view VWAP was from the start of a new trade day. I found I could change the number of days to view the cumulative VWAP for as many days as I wanted, and this allowed me to choose the day where I could set my anchor. This hack allowed me to experiment with the week-to-date WTD, month-to-date MTD, and year-to-date IT, as well as from gaps and even IPOs. VWAP analysis immediately fascinated me, and more importantly, I started to make more money in my trading with it. I was hooked by the possibilities of AVWAP analysis. It remains my most important technical analysis tool to this day. It wasn't until 2015 that a major technical analysis platform, TC2000, added anchored VWAP by Alpha Trends to their excellent chart platform. This was a significant breakthrough for its simplicity and the ability to point and click the anchor from any point on the chart, on any time frame. From that introduction to the trading world, there have been several chart applications that have added the Alpha Trends anchored VWAP to their platforms. I am truly grateful that the trading world has embraced the value of AVWAP analysis, and am humbled that my efforts have made it possible to access the anchored VWAP on many great chart platforms. See the list of chart platforms with AVWAP in Appendix C, sources for anchored VWAP on charts. How VWAP and AVWAP help traders. The way the AVWAP combines price, time, and volume into one easy-to-understand indicator gives us a blended view of whether it is the buyers or sellers who are in control. This also applies to the VWAP, but for purposes of this book, we are generally focusing on the AVWAP. This valuable information allows us to better understand market structure so we can identify low-risk, high-probability market and individual stock opportunities, time our entries into the market and individual stocks more accurately, stand aside through periods of uncertainty, cut our losers early based on objective recognition of price action, hold our winners longer, exit our winners more efficiently. In short, AVWAP is a tool which can help any time frame participant, from day traders to longer-term investors, make better market timing decisions and achieve greater market profitability. On a chart, the VWAP is represented as a line along with price. The way it builds with each piece of data allows us to recognize nascent trends. In the chart 1.2, on the left it shows that buyers are in control of the daily session while the stock is above the ascending VWAP. The chart on the right shows that the sellers maintain control while prices are below the declining VWAP. Who is in control, bulls or bears? The AVWAP shows us the genuine relationship between price and volume over any period. Which side is in control and gaining or losing control of the trend, buyers bulls or sellers bears? Our job is to objectively listen to the message of the market for the time frame we wish to engage in our trades. The AVWAP provides as much certainty as we can hope for in the study of price action. We can measure AVWAP on any security or market where price and volume data are available. That includes individual stocks, ETFs, futures contracts, cryptocurrencies, and forex markets, VWAP or AVWAP. Do not let the terms VWAP, AVWAP, and VWAP anchored from confuse you. In this material, you can assume that any reference to VWAP on its own is for one day. If it says AVWAP, it refers to anchored VWAP, and we might also say the VWAP from, which means from the anchor point, and that makes it an AVWAP. There are dozens of technical indicators that we can choose to use in our analysis of stocks and other markets. The VWAP and ability to anchor it from key price points as an AVWAP is the most accurate visual representation of who is in control of the market from any specific point. At first glance, the study and implementation of an AVWAP may seem complicated, but it is a simple study anyone can learn and easily apply to their market analysis and decisions, regardless of time frame. By the time you have read this book, you will recognize the ways the AVWAP simplifies how to observe and more accurately analyze market action. Chapter 2, Price, Time, and Volume. Time and Tide Wait for No Man, Geoffrey Chaucer. Chapter Objectives. 1. Understand why price is the most important piece of information in the market. 2. Understand how price creates new information. 3. Debunk news media reasons for price movement. 4. Understand that bull and bear labels are meaningless without reference to time frame. 5. Identify uptrends and downtrends based on the direction of the highs and lows. 6. Understand how trends are formed and why you should trade with them. 7. Understand the difference between a price correction and a time correction and their implications for trend continuation. 8. Understand the deeper meaning of what volume tells you about a stock. 9. Learn how volume adds meaning to our AVWAP analysis. 10. Understand the importance of price, time, and volume. When you build a puzzle, you start with the easiest pieces first, the edges. The edges frame the foundation of the picture. You work from the edges to the next obvious parts like a bright object, oddly shaped pieces, and so on. Slowly, more of the structure of the scene reveals itself and the pace of progress quickens until you lay in that last satisfying piece to complete the puzzle. The components of VWAP are price, time, and volume. These are the edge pieces in our study of market action in search of the next big winner. On stock charts, price, time, and volume come together in a way that allows the trained eye to objectively identify whether buyers or sellers have control of a stock's trend from any start point. From there, we can build our trade plan to find the lowest risk, highest probability trade opportunities on any time frame. What is price, and why is it important? We define price as an amount of currency that will purchase a finite quantity, weight, or other measure of a good or service. In the markets, it represents the price where the last transaction occurred. It is said, don't confuse price with value. Nowhere is this truer than in the markets. Price is the fastest moving market variable. Price creates new information. Price reflects the aggregate of traders' strategies and expectations about the market's future behavior, and, as a part of that, the current news headlines and events which affect our economy. It also creates new information. When prices change, it can cause others to enter or exit the market based solely on that price move. That is what technical trading is all about. Prices cause and effect. In a supply and demand-driven market, also known as a liquidity market, price change is not only the effect of participants' actions, but it can also be the cause which motivates participants to act. The most important price, whether we gain or lose on a trade, is based solely on the movement of price. There is no other meaningful measurement of success in the markets. It is all about your profit and loss, your P&L. If you have a position in a stock, the most important price is what you paid and how the market has responded since you got involved. Time and multiple time frames. Without any other reference, a simple statement such as, "I will call you at 9 o'clock," has little value. Is that AM or PM? Which time zone are we talking about? What day this week? In the markets, time and trends can also be ambiguous. When people say they are bullish or bearish, those pronouncements have little value without a reference to time. While it may make sense to say to a friend or business associate, "I will call you at 9 p.m. next Tuesday," in looking at market trends, we cannot be so precise with our bullish or bearish labels because trends may conflict on different time frames. If you were to ask if the stock in chart 2.1 was in an uptrend or a downtrend, either answer could be correct. It depends on your time frame. The longer-term trend is clearly higher, as represented by the big green arrow, but it doesn't mean you could just buy at any point and make money. If you purchased at the start of the smaller red arrows that mark short-term downtrends, you wouldn't benefit from the longer-term uptrend until the trends came into alignment. Why and how to use multiple time frames? We have established that multiple trends exist for the same stock on different time frames. The best approach is to use the time frames together. When we do this, we avoid the confusion of bull or bear labels so we can focus on how the market operates and how to make more money. First, we start with the long-term time frame to determine overall money flows. Next, we move to the intermediate term to plan our trade. Finally, we consult the short-term chart to fine-tune our entries and exits. Chart 2.2 blends 3 timeframes for the same stock. Look at the bottom axis for the time reference. We start with the long-term time frame, 3 months, to determine overall money flows. We then move to the intermediate term, 3 weeks, to plan our trade. And finally, we consult the short-term chart 1 day to fine-tune our entries and exits. Now let's look at the price action in chart 2.2. To the left are daily candles, with the shaded portion highlighting the last 3 weeks. When we switch to a shorter time frame, it allows us to see more detail of the longer time frame, like looking through a magnifying glass. The 3 weeks referenced in the middle chart are shown in more detail, 30-minute candles instead of daily candles. This middle chart's data is a closer look at the data shown in the blue highlighted portion of the leftmost chart. However, the middle chart shows activity at 13x magnification. There are 13 30-minutes periods per trading day. The blue shaded part on the middle chart is further magnified on the 1-day chart on the right. The activity on the 1-day chart is displayed in 5-minute candles instead of the 30-minute candles in the middle chart. If you look closely, you'll notice that this final chart shows only the last day of the left chart. Since the 1-day chart is constructed of 5-minute candles, of which there are 78 in each 390-minute trading day, it is like looking at 78x magnification of the left daily chart. Volume. Volume is the V in the VWAP. Volume simply measures the number of shares, contracts, options, and the like transacted at a price or in a price range for various time increments. Vertical bars display trade volume under the price information. Volume is used to confirm or reject price direction, not as a timing signal. When we learn to interpret the price/volume relationship correctly, it allows us to better gauge the strength of a trend and thus greater confidence in our own decisions to buy, sell, or stand aside. Here are a few ways volume is important to our analysis. It assigns meaning to movement, measured in a more subjective but more in-depth manner than price action alone. It offers insight into market psychology. It allows us to measure the emotional intensity level of the participants in the market being studied. It adds a dimension to price study that can confirm price action or signal caution that a move may have difficulty sustaining momentum. The traditional way to show volume is directly below the price action. Chart 2.3 shows the volume color coded to the candle above. Green volume bars represent the candles where the daily market closing price was higher than the opening price, and the red volume bars represent the days where the closing price was below the opening price. Price and volume relationship. Volume is the best representation of how committed participants are to a market at any point. A healthy market move will see volume expand in the direction of the primary trend, peak near turning points, and diminish on the counter-trend moves. High volume relative to normal trading activity can signal times of stronger confidence in a move, while low volume times are often a healthy pause as the market digests a price move and traders consider their next trades. A drop in volume in an uptrend is not always bearish. It is often a simple lack of supply in a stock with healthy demand. You want to be aware of the volume trend, but if it doesn't confirm price action with a volume expansion in the direction of the trend, it is not a reason to act, just something to be aware of. The purple line overlaid on the volume bars is the 20-day moving average. Volume is always second to price. Volume analysis can supply us with important information about the conviction of the buyers and sellers in a market. It is important to remember that volume is always secondary to price, as in the end, price is the only thing that pays. We now turn to how institutional investors use VWAP and AVWAP concepts. Chapter 3: Institutional Background and Algorithmic Trading. Stocks never go up in price by accident. There must be large buying demand. Most of this demand comes from institutional investors, who account for more than 75% of the buying of the better quality, leading stocks. William J. O'Neill from 24 Lessons for Investment Success. Chapter Objectives. 1. Understand how and why institutions use VWAP and AVWAP. 2. Understand institutional orders. This chapter delves into how and why the VWAP became, and remains, so important to the largest participants in the market, institutional investors. If we know how institutions use VWAP as an execution tool, we have a better understanding of how to apply it as an analysis tool for our benefit. When we can recognize the actions of the largest market participants on a chart, we can join in on emerging trends in individual stocks and the overall market. Why institutions use VWAP. Volume-weighted average price, VWAP, was first referred to in March of 1988 in the Journal of Finance article entitled The Total Cost of Transactions on the NYSE by Stephen Berkowitz, Dennis Logg, Eugene Noser Jr. This is essentially when the VWAP was invented. In the article, the author stated that the volume-weighted average price on any day represents the price a naive trader can expect to obtain. This article ignited the study, analysis, and implementation of VWAP strategies, which continues to be developed to this day. Originally, the VWAP was a benchmark to measure whether an institutional customer received a fair execution of their order by the broker who bought or sold a stock on their behalf. The difference between the reported price of a trade to the institutional customer and the VWAP let the customer objectively determine if their broker did a fair job in the execution of their order. The customer wants to know if they received fair value for the time it took the trades to complete. A portfolio manager wants to know how the price they paid compares to the average price of the stock during the time it took for the order to fill. If an order is filled at a price worse than VWAP, it brings into doubt the trading ability of the broker and may cause the manager to reevaluate the relationship and give their lucrative commission business to another firm. Institutional benchmark example. If the broker purchased 2 million shares at an average price of $20.45, and the VWAP during that time was $20.60, then the customer should be happy. They paid $0.15/share less than the average transaction during that time. If, however, the customer order was purchased at $20.80 when the VWAP was $20.60, the customer would be unhappy with the broker. No one wants to pay more than the price a naive trader can expect to obtain. Customers give more business to firms who consistently do well for them, which means bigger revenues and bonuses at year's end. This objective measure aligns the goals of the broker and their customer. This easy-to-understand benchmark comparison is why algorithmic VWAP orders make up most institutional activity. A large percentage of institutional orders in the markets today are executed as VWAP orders. These orders try to obtain a buy or sell price as close to, or better than VWAP during the time it takes to complete the buy or sell order. Most brokerages allow their customers to receive a guaranteed VWAP price for their orders. These orders reinforce the importance of VWAP, and thus AVWAP, through volume participation algorithms. Volume participation. Since large blocks of securities are rarely bought or sold in one single transaction, the true aim for a large VWAP order execution is not the best price, but liquidity. The goal is to make sure the order gets filled in the time allocated with minimum market disruption. The time to fill the order is irrelevant. It can be a large fund buying millions of shares of a stock over a month or a longer period, or it could be an order to sell 250,000 shares of a stock between noon and the 4 p.m. close. Market direction is not an actual concern for VWAP order algorithms. The goal is to take part in volume proportionately through the day, or whatever the period, it takes to execute the order in full. Algorithms. We often hear traders mention the algos in a stock. This refers to the automated buy and sell programs run by large institutions. A trading business will try to squeeze performance and margins anywhere possible. It's about being efficient. The pursuit of efficiency in the markets has led to the development of computerized models to remove some variables where humans might not do as good a job as a computer. Trading can be tedious for a person. A computer can refresh or change bids for offers with no human interaction. Sometimes, to complete a single order, it might take hundreds of individual trades to fulfill it. Computers do not get tired, and the algorithms do what they are programmed to do without mistakes. Institutions do not want to disrupt the market with large orders, so their algorithms slice a large order into smaller orders. Smaller orders also mask the true size of their order from other market participants. This is important so that their orders are not front-run, cut in front of by other participants. These programs reduce market impact cost, which, of course, help increase performance measurements. Market impact cost. Market impact cost is the effect a market participant has on the price of the asset it is trying to buy or sell. If a stock trades 1 million shares per day on average, and you try to buy or sell so many shares that they constitute a large portion of the average daily volume of those shares, those buy and sell orders are likely to move the price of the stock. The pressure your buy order places on the supply and demand equation can cause an adverse price move, which forces you to buy at a higher price than intended. The same is true for a large sale of a stock. Your own sell orders have the potential to push the price lower, which makes your average sale price lower than intended. VWAP trading algorithms attempt to minimize overall costs by reducing the market impact cost of the execution of a large order. Market impact cost is reduced by the amount of time over which the order is spread, as well as the intervals, breaking large parent orders into smaller size child orders. Posing buy and sell orders with different brokerages, different institutional goals. The focus of the strategies in this book are VWAP-based trend trading and momentum, but it is important to recognize there are other strategies implemented every day by other style and time frame participants. Some institutions buy more shares of a stock if it is under the VWAP because they perceive it has value relative to the average participant price that day. These same buyers will then sell shares into the stronger demand for shares when the stock is above VWAP since, by doing so, they receive a premium over value during that period. As a group, institutions are as diverse in their strategies and time frames as retail traders. There is no one strategy that fits all. It is not just as simple as saying institutions buy below VWAP. It may be the goal of a value institution to make their purchases, while stocks are below VWAP, but a momentum fund might try to juice a trade in which they have a long position in order to induce others to buy the rising stock and create further upside momentum. As we will show in Part 2, Chapter 10, when we discuss short squeezes, buyers will sometimes become very aggressive about their purchase, hoping to inflict pain on trapped short sellers. Parent and child orders. Large market participants do not want to tip their hand and reveal to the market that there is a big buyer or seller present. They need to disguise their orders to reduce information leakage. Disguise a large order and avoid having their orders front-run and reduce their market impact cost. Large parent orders to buy or sell an individual stock get broken into smaller child orders. A study of VWAP trades executed by the International Trading Group discusses this point in detail. The sample size is 243,772 parent orders. The algorithm executed 13,468,847 child trades, meaning that on average each parent order turned into 55 child executions. In his testimony to Congress in 2021, Ken Griffin, the CEO of Citadel Trading, stated, "Today, virtually all trades executed by institutional investors are in the form of program trades, such as VWAP and other algorithm trades." According to their website, Citadel Trading executes approximately 35% of all U.S.-listed retail volume, making us the industry's top wholesale market maker. Griffin said, VWAP trades are not large trades. It is not like there are 10 million shares to be bought. It is a trade that is sliced into small slices, 100 or 200 shares, and executed over the course of a day, a week, or a month. I emphasized Mr. Griffin's words about time frame because they show directly that VWAP orders are not just for one day. They are also used for larger trades, which can take days, weeks, or months to execute. Remember this point when we study how longer-term VWAP levels will often act as support and resistance levels. Example, large institutional sale order. Let's consider a situation where a mutual fund owns 3% of the total outstanding shares of a stock. For whatever reason, they want to reduce their position size by half. If there are 500 million shares outstanding, they own 15 million shares and would have to sell 7.5 million shares of the stock to sell half of their position. Let's say the stock trades 2 million shares per day. If the fund dumped all 7.5 million shares of the stock on the open market, they would flood the market with close to 4 times its average daily volume with this transaction alone. A sale of this magnitude would cause a huge imbalance in supply and demand, and the stock would drop considerably to find enough liquidity to fill the order. A sloppy sale like this would cost the fund a lot of money and hurt their performance. Rather than dump their stock all at once, it is more likely the fund would contact their broker and let them know they have a large block of stock to sell. The broker may choose to purchase the stock directly from the customer at a negotiated price. The broker would then sell it over a period, which would allow the large supply to be absorbed into the market more easily. In this scenario, the broker takes the risk of selling the stock, and they could probably purchase the 7,500,000 shares at a discount to the current price. The discounted price given to the fund is to compensate the brokerage for taking on the price uncertainty and associated risks during the time it would take them to liquidate the stock. If the fund was not inclined to accept a discounted price of the shares in return for the transfer of the risk, as well as for the immediate liquidity created were the broker to buy all of the 7,500,000 shares, the fund may instead hire the broker to sell the stock using a sophisticated VWAP algorithm. In this scenario, the fund may decide to have the brokerage execute the order over the next 30 trading days, and approximately 125,000 shares would get sold per day, just 6.25% of the average daily volume, a number that the stock would be better able to handle rather than a sale of all 7,500,000 shares at once. Time slicing. Even with the liquidation of just 125,000 shares per day, there are certain precautions the broker will take to ensure they do not cause a disruption in the market that would impact their efforts for a fair price. Just because traders generally will accept the price a naive trader would expect doesn't mean traders are dumb. The broker will not simply sell 125,000 shares at one point in the day. Instead, this is where time slicing of the order comes into play. The broker considers the average daily volume of the stock for the number of days it expects it would take to liquidate the order in full. In our example, they might consider the 30-day average volume. Once they assess that there is sufficient liquidity to handle their 125,000 shares per day, they would then consult a volume distribution chart of the stock over narrower timeframes. It is common to see this U-shaped curve in the markets, with the heaviest volume in the first and last hours of the day. This U-shaped pattern occurs in the broad indices and in individual stocks. The typical day experiences a volume surge in the morning, a midday slowdown, and a larger volume into the close. It is like a runner who starts a race quickly, settles into a sustainable rhythm, and then tries to finish the event with everything they can. Because of volume participation orders, the programs reinforce this U-shaped pattern. Not all institutions will use the same time periods. They may be 5, 10, or 15-minute periods, or any time equally divided by the 390 minutes in a trading day. To achieve a price execution as close to the daily VWAP as possible, our institution would carve their 125,000 shares per day parent order into several child orders. Let's say the first 5-minute period of the day, the stock typically trades 2% of the full daily volume. The institution would then sell 2% of their 125,000 share order, that is, 2,500 shares in the first 5 minutes of the day. By using a time increment, the institution executes a larger portion of their order at the most liquid times of the day, and they sell fewer shares during the less liquid times of the day. Participation in a small portion of volume during each period makes it less likely that other traders will detect the broker's selling activity, and even less chance that the broker's sales would be harmful to the average price the stock trades through the day. Institutional orders may take place all day or during a time slice of the day. VWAP orders are set by, duration by, or sell over a portion of the day full day, week, month, or other relevant period, price limits, volume percentage limits, or other pertinent criteria. There is no standard time increment for a VWAP program to slice its orders. It is up to each institution to choose how granular they want to be. An example of a shorter-term VWAP order could be buy 250,000 shares of Opel from 1:04 p.m., pay no more than 0.25% above VWAP, and don't constitute over 10% of the volume. Often, the brokerage firm does not know the true intention of the customer they represent on a transaction to buy or sell. In fact, customers often use multiple brokers to avoid the markets knowing their true intent. It is not uncommon for a net buyer of a stock to give sell orders at certain levels with competitive algorithms that drive the price back down to VWAP, where they have a larger buy order ready to be filled. What about dark pools? Dark pools are private exchanges designed to facilitate block trades between institutional investors. These transactions are not reported to the exchanges in the consolidated tape, which can be a criticism of VWAP analysis. Volume on dark exchanges is generated by funds who swap large positions with other institutions at a negotiated price and are not buys and sells that affect price change. If we don't see these transactions, and neither do other participants who look to volume for directional clues, does it matter? Does a tree make a sound when it falls in a forest? The fact is, we never have the complete picture of who or why someone transacts in a stock, if their position is hedged, or if their trade is part of a more complicated strategy. Risk is ever present in the market, and one risk is a lack of complete information. We must make certain assumptions in our analysis, which is why risk management is always at the cornerstone of any strategy we implement. Even Warren Buffett uses VWAP. Chart 3.2 shows how Warren Buffett sold his entire position in Southwest Airlines over a 2-day period. The reported price he received from the sale of his 2.3 million shares was $32.22, which was the exact VWAP for those 2 days. It is likely that Mr. Buffett negotiated a guaranteed VWAP price for his sale with the broker. Looking at the chart, it doesn't seem like the broker made money on this order since, for most of the time, the stock traded below the declining VWAP of the time it took to fill the order. Warren wins again. Now that we have made it through this tedious section with a solid introduction to how institutions use VWAP in their daily business, we can move forward to the more useful aspects. Chapter 4, Market Sentiment Tools, Psychology, and Anchoring. If you do not know who you are, the market is an expensive place to find out. Adam Smith. Chapter Objectives. 1. Define market sentiment tools. 2. Recognize AVWAP as a market sentiment tool. 3. Understand how your psychological makeup impacts your trading. 4. Understand the anchor bias and how we relate it to our trading. In the prior chapter, we discussed several aspects of how institutions accomplish their trading goals and how their trading creates an impact on the market. While institutional traders and their trading strategies have a large influence on the market, they are not the only influence on the market. Less tangible but very important factors are the psychological and behavioral motivations of all traders. We now look at some of the micro U and the macro, the market, psychological and behavioral factors that affect trading. Your mental makeup, how you handle stress, and how you think about and manage risk are all important components that will matter more to your success than any system or perceived edge you bring to the market. Behavioral finance attempts to understand financial decisions through the combined analysis of psychology and investing. It is the study of how human and social emotional biases can affect price behavior and how to measure it. As with any market measurement, the goal is to gain insight to increase profits. Any discussion of market psychology can sound intimidating at first, but we do not have to possess an advanced degree to understand what drives market behavior. Instead, we need to have some common sense psychology. Look at any chart and imagine how you would feel if you were long, short, or in cash. As we analyze multiple time frames and use tools like the anchored VWAP, we gain a greater sense of market psychology, market sentiment. Market sentiment refers to the overall attitude of investors toward a particular security or financial market. It is the feeling or tone of a market, or its crowd psychology, as revealed through the activity and price movement of the securities traded in that market. In broad terms, rising prices indicate bullish market sentiment, while falling prices indicate bearish market sentiment. Investopedia.com, Sentiment attempts to quantify a nebulous concept of the collective psychology of the market participants. While quantitative studies measure facts about price behavior, we can think of sentiment as opinion mining. Market sentiment represents the mood of the market, bullish or bearish. It tries to measure crowd psychology. The market does not care about the opinion of an individual. It is the cumulative opinions and actions of participants and price movement that matter. Why are we interested in market sentiment? Crowd behavior determines how and why trends begin, continue, stall, and reverse. People are more alike than different, and that is certainly true in the markets and in what drives our emotions to buy and sell. If we understand the individual factors that motivate the crowd, we can put our personal biases aside, anticipate crowd behavior, and plan our trade around their actions. There are things to be aware of in the market that do not always equate to a reason to buy or sell. Seasonal tendencies and extreme bullish or bearish measurements are good to be aware of, but they play a minor supportive role to price action. The goal of sentiment measurements is to gain insight into the psychology of the other market participants in order for you to find an edge and determine whether they may be buyers or sellers of the overall market or individual stock. Traditional sentiment measures. There are no shortage of traditional measurements of market sentiment. Some of the popular ones such include the SIBO Volatility Index, VIX, the NYSE 52-week highs versus lows, the NYSE bullish percentage, the percentage of stocks above or below a 50 or 200-day moving average, Investors' Intelligence Sentiment Poll, and others. More recently, data from social media messages on Twitter and stock twits or Google searches can be used by smart algorithms to assess the mood of the market. Markets are not always logical and rational. Sentiment can change for events that seem unreasonable or lack a reason, but there is always a reason for price change. We simply aren't always privy to the news. This can be a source of frustration for many market participants. Emotions and biases influence traders and investors, but they also blend with rational thought processes. Human biases are a significant reason that algorithmic trades have become the dominant source of buying and selling in our markets. Humans make mistakes and act on impulses and emotions. Algorithms are designed to minimize human errors. It is easy to get bogged down in the intellectual aspects of markets and trading in order to gain an edge, but, as we know, only price pays. This brings about the need for an objective measurement, and anchored VWAP serves that purpose, because the AVWAP can simplify and help us distill or quantify the market sentiment by allowing us to measure the result of all of the sentiment influencing biases, news, and behaviors, rather than obsessing over those factors. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. Benjamin Graham. Personal psychology and anchoring. Before we attempt to understand the behavior of crowds, we need to begin with an assessment of our own mental inventory and the factors that influence the decisions we make in the markets. The market does not care about our individual opinions of price action or when we buy and sell. It is the collective actions of the participants, both by humans and by the algorithms programmed by humans, that create crowd psychology. I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times. Bruce Lee. A few of the personal factors that play into individual financial psychology include age, time frame, risk tolerance, funds available, time available to commit to the markets, whether you are a fast or slow thinker, and others. One of the first goals of any market participant should be to find a combination of 1. An approach or strategy, and 2. A time frame, which together fits your personality. These two critical pieces of the puzzle are often overlooked, as people jump from style to style without ever committing to one. Always be curious about alternative approaches, but try to become a specialist in just a few setups, developed from your experience in trading as you follow an overall plan that suits your personality, so that you can consistently profit. Anchoring bias. Daniel Kahneman is a psychologist and economist who won the 2002 Nobel Memorial Prize in Economic Sciences. One of the investor biases identified by Kahneman is the anchoring bias. Investopedia defines anchoring bias as the tendency to be over-influenced by the earliest information presented to us when making decisions, thus allowing oneself to be driven to a decision or conclusion that is biased towards that initial piece of information, the anchor. Anchoring is a cognitive bias known as a heuristic or rule of thumb. In the markets, our cost basis is the personal scorecard by which we measure the success or failure of our trade or investment. The price we paid becomes our anchor point. It is the basis of our price memory. It is our subjective anchor point, which can influence our future buying and selling decisions. Here are several types of anchoring biases that can negatively affect your trading strategy if you are not mindful of them. Personal anchors. We all have personal dates that we anchor from. Think of your birth date or our IPO and the annual celebrations of that day. We also attach significance to other dates, such as graduations, anniversaries, or holidays, or even casual anchors. She seems so much happier since she met Bob. These are mental reference points to which we assign meaning in order to keep track of our progress, or lack of it. These subjective events can influence our thoughts and even our behaviors. I experienced the anchoring bias after going through a divorce. My account equity was divided in half in the divorce settlement, and I was anchored to the previous higher balance. I found myself swinging for the fences because I had a smaller account and tried to get it all back at once. Because my anchor was the previous higher balance, it clouded my judgment and decision-making. When I quickly grew my post-divorce account balance by 50%, I didn't view it as a victory. I was still anchored to the pre-split balance and viewed the account as being down 33% from the former peak. My anchor point didn't allow me to see my positive performance for what it was, a 50% gain. It wasn't until I got back to my anchor of my pre-divorce equity high that I was able to view my gains as more than simply a return back to even. Price target mental anchors. Consider the danger of price targets as anchors for a stock. If an influential analyst appears on television and mentions that he is bullish on XYZ stock, which currently trades at $55, but that his price target is $150. When people hear such a bullish proclamation, they often get anchored to that target and neglect risk management. Instead of raising their stop to protect accumulated gains as the stock climbs, they fixate on the price target the expert projected. It is a shame to see anyone purchase a stock at $55, ride it up to $100 or more, and refuse to sell as it weakens because the analyst said it would go to $155. Don't get stuck on a price target and refuse to take gains when it is prudent, or worse, ride the stock all the way back down to the purchase price, or lower. Winners do not take care of themselves. You need to manage winning positions based on price action. We will discuss the use of AVWAPs as stop levels in the strategies section. Whenever I share a trade idea for a stock, I have a general idea of where the price has the potential to go, but I seldom mention a specific price target. Often, the level I believe the stock can move to is an AVWAP from a prior high, which becomes a level of interest where resistance, which is discussed in detail later in this book, may be found. I look at these levels not as price targets, but a place we could reasonably expect the stock to travel to. Rather than mention a price target, I refer to worst-case stop levels pertinent to my time frame. I don't want to fill people's heads with ideas of riches fueled by outrageous price targets. Instead, I want people to remember the cardinal rule: risk management is always job one. Influence of market anchors. An anchor price held by a larger group of participants will have far greater significance than one held by a handful of people. The greater the market's price memory for a stock, the more likely that memory effect will influence future crowd behavior. Market crowd is a more reasonable measurement than our personal anchors because it represents a consensus of the market participants' mindset. We can never possibly know the reasons or motivations of each individual participant to buy or sell, and fortunately, we do not need to. Important anchor points. We derive shared market anchors from various events deemed significant to the market. When there is an event which causes a big shift in the market's psychology, it becomes a level to anchor a AVWAP. These events can be a price breakout for no reason other than price action, or we may associate it with a fundamental catalyst such as an earnings report, industry or sector news, or an economic report. We will explore the individual catalysts and specific anchor points in depth in the strategy section. Suggestions and ideas for personal trading practices. Understand what you can control. There is little we can control in the market. This can be a source of frustration to those without a solid understanding of market structure and a plan to deal with uncertainties and market surprises. The illusion of control is greater than its reality because of the subjective nature of our analysis. While we may do our best to make sure our analysis is unbiased, the market will throw surprises at us, which can devastate our accounts in the short term. We want to plan for the best and prepare for the worst. That is why an exit strategy for our losers is so important, working with heightened uncertainty. Initially, you can control the size you commit to a trade, but market environments are never the same. Sometimes the market seems to fire on all cylinders, and it feels as though you can do no wrong, and those are times to go for it. Other times, often during earnings season, the times of the year that earning reports are published, there is a greater sense of caution in the market, and those heightened periods of uncertainty are the time to slow things down. If we were to investigate the daily P&L of an emotionally intelligent trader, we would find occasions of trading actively and occasions of standing back. We would see periods of high risk-taking and periods of caution. All markets are not created equal. Some bring more opportunity, some less. The self-aware trader knows when it's my market and goes into opportunity-seeking mode. That same trader knows when it's not my market and preserves capital. Dr. Brett Steenbarger, Trading Psychology 2.0. In uncertainty, cash is a position. We can adjust our market exposure with a reduction in our share size risk amount per trade, be more selective in the stocks we trade, switch to a shorter time frame, or maybe employ a different strategy than what we typically do. We can also just sit on the sidelines in cash. Cash can be the best position if you don't perceive an edge or insight that will help you be profitable. Cash gives us the ability to observe objectively rather than force inferior trade setups. One of my favorite market phrases is, "It is better to be on the sidelines and wish you were in than it is to be in the market and wish you were out." Fear of missing out, FOMO. Before we move on, let's discuss the fear of missing out, FOMO. FOMO is described as anxiety caused by the belief others may have more fun or, in the markets, may make more money than you do. Those who have a plan and buy stocks properly do not experience FOMO. It is the Johnny-come-latelys who read news about a company, look at the soaring price and cannot resist but to get involved. Rather than wait for a low-risk entry point, they throw caution to the wind and chase the stock higher. The fear is that a stock will soar to record highs while they do not have a position. This can be a powerful motivation to chase the stock, even after it has already experienced a large, short-term move and may, in reality, have little or no further upside. These are risky purchases because it is difficult to keep tight stops and limit losses if the stock reverses. If you miss out on the first move a stock makes, then it is better to wait. Often, the stock will undergo an orderly correction by price or through time and then provide a low-risk opportunity to get involved. If the stock doesn't pull back and give you a new buy point, remember this phrase, missed opportunity is better than lost money. Embrace the JOMO, joy of missing out, because you stayed disciplined with your approach. Contrarian trading. We define a contrarian as someone who opposes or rejects popular opinion. In the markets, it means to trade against trends, to buy when the trend is lower, and to sell when the momentum is higher. Sentiment indicators attempt to identify extreme levels where a trend may tire, so a contrarian can make a trade in the opposite direction. As you may have guessed, I am not a contrarian trader. I believe the trend is your friend until it bends or ends. To trade in the direction of the trend is mathematically correct. In an uptrend, the sum of the rallies is always greater than the sum of the declines. If we buy correctly, as a move begins, and not by chasing prices after the trend is underway, and manage risk with an appropriate trade size and a strategy to cut losses quickly, there is no reason to be smarter than the rest of the market. It may be difficult to accept price action as being reasonable when stocks make big runs. It is said, the collective intelligence of the crowd sinks to the level of the least educated participant. If price action makes little sense, it is not a reason to be a contrarian and bet against the crowd's behavior. It is a reason to study the action more carefully on shorter time frames and plan for a potential reversal. There is no such thing as a stock's being up too much if there are more buyers. Likewise, there is no such thing as a stock's being down too much if there are still sellers present. A brief discussion of stop losses. A stop-loss order is designed to protect your capital after you start a new position in a stock. As we know, risk management is always job number one. That job begins in the planning stage of the trade when you determine what your maximum risk will be on the trade. There are two common types of stop-loss orders, the stop market and the stop limit. A stop market order simply says, if the stock trades at 24.35, sell my stock at the market. The stop limit order gives you more control of the order. It might be entered as, stop 24.35 with a limit of 24.20. For the stop limit, it will sell the stock as soon as the stop is triggered with a trade at 24.35, and it will continue to sell the stock down to a limit of 24.20. The placement of stop orders is discussed later in more detail. Chapter 5. Anchored VWAP Components and Comparisons. Get the fundamentals down and the level of everything you do will rise. Michael Jordan. Chapter Objectives. 1. Understand the difference between VWAP and AVWAP. 2. Understand how the AVWAP is created. 3. Understand similarities between AVWAP and dollar cost averaging. 4. Understand how to use AVWAP to achieve market goals. You can measure the VWAP and AVWAP for any financial product where price and volume data are available. The traditional VWAP is the volume-weighted arithmetic mean of all trades for one day. When we change our measurement period from the start of the day, it becomes anchored to a user-defined starting point. The idea for a point-and-click anchoring of the VWAP is one that I had been thinking about from the first time I used the VWAP in 2003. It was in 2015 when TC2000 implemented this feature at my request. Since then, dozens of other technical analysis platforms have followed their lead and made it available on their charts. By calculating the volume-weighted average price starting at an anchor point, the VWAP becomes an AVWAP, anchored VWAP. The AVWAP calculates the cumulative and dynamic, adjusts in real-time VWAP from the anchor point forward. With the AVWAP, you can better understand the shifts between buyers and sellers that occur over all time frames, not just from the start of a day. The calculation and interpretation of VWAP and the AVWAP is the same regardless of the anchor point or the time frame analyzed. In short, the anchored VWAP is a VWAP with a specific time anchor point chosen by the trader. If the VWAP begins at any point other than the start of a new day, it is the VWAP anchored from the start of the measurement, or AVWAP. In the AVWAP calculation, each share receives equal weight. It does not assume that an institutional share traded is more important than a share traded by a retail trader. One share, one vote. The AVWAP averages price and volume from any point to show us who is really in control of the trend. It is a quick and easy way to identify the trend from the start of the anchor point. It keeps us on the right side of the market. The trend is your friend. The AVWAP is a technical tool that allows us to determine who is in control, buyers or sellers, from any point. It shows us how well they maintain control, or if there are signs of a trend slowdown or potential reversal. Regardless of time frame, when the stock is above the AVWAP, the buyers are in control, and when it is below the AVWAP, the sellers are in control. In the remainder of this book, you'll find me using the phrases guilty until proven innocent and innocent until proven guilty. What I mean by them is that the benefit of the doubt should go to the direction of the trend. A trend, once established, is more likely to continue than reverse. Is a tenet of technical analysis. AVWAP, an unbiased analysis of market flow. AVWAP analysis allows us to be more discerning in our analysis and in the trades we make because it gives us a stronger understanding of how capital flows through markets. It helps us to identify important price levels in the market where sentiment is likely to change. When we recognize these levels in advance, we can study them more closely on shorter time frames. On these shorter time frames, we look for evidence where buyers or sellers may gain an edge. We want to identify the key levels where we can plan our trade, whether entering or exiting the market, by figuring the risk/reward ratio. Then we patiently wait for price confirmation before we execute and put our money at risk. Once in a position, our job switches from analyst to risk manager. Dollar cost average, DCA. Easiest way to understand the volume-weighted average price, VWAP, is to consider the investment strategy known as dollar cost averaging. The DCA strategy is to invest a fixed dollar amount at a regular interval, such as once per month. When you invest the same amount each month, whether the market is up, down, or sideways, it reduces the timing risks for longer-term investors. DCA is more about time in the market versus timing the market. If you invest $1,000 each month into your favorite long-term stock, at the end of 1 year, you will have invested $12,000 in the stock. When you decide to sell your stock, you need to report your cost basis to the IRS so they can collect their fair share of the profits. How do you calculate your average cost per share? Do you take the 12 separate purchase prices, add them up and divide by 12? These may give you an approximate price, but the IRS will not like it when you give them this half-assed calculation when it is time to pay taxes on your big gains. Table 5.3 shows the stock price paid for each of the 12 purchases. When you invest a constant dollar amount, $1,000 a month, and the price of the stock fluctuates, you will purchase a different number of shares each month. When the price of the stock is lower, you will purchase more shares, see month 1, and when the price is higher, see month 12, you will purchase fewer shares. At the end of this 12-month period, you will have accumulated 209.05 shares of the stock. Your dollar cost average paid for the stock would be $57.40, $12,000 divided by 209.05. In essence, $57.40 is the volume-weighted average price VWAP of your investment. The mathematical average based on price alone would be $59.42, which is not the correct number. In plain English, we multiply the price of the trade by the total number of shares traded at each price, and that number is then divided by the total number of shares traded to come up with VWAP. Fortunately, we do not have to do these calculations. They are built into any decent chart platform. The VWAP starts at the first data point, whether it is 1 minute, 30 minutes daily or other period, and builds with each new trade. The more volume traded at a certain price level, the greater the weighting and more impact that price has on VWAP. Similarly, the larger the time frame calculated, the less impact each new period will have on the weight. Data settings. When the user chooses the time frame to study VWAP, there may be an option for how the VWAP is calculated in your charting software. To achieve the most accurate VWAP value, you want to use the shortest time frame available without affecting the ability to see it clearly on the chart. See Chart 5.5 to see how the data can appear to be scrunched up on shorter time frames where there are more candles. Unless we use tick data, which uses every transaction in the calculation, all VWAPs that do not use tick data will be a very close approximation to the actual VWAP. For our purposes, the variances are not critical. Just remember, the shortest time increments will provide the most accurate VWAP approximation. For intraday trading, tick data is the absolute accurate number for VWAP because it averages every single trade. Many platforms do not allow for such precise data, and some allow for intra-minute, 10, 15, 30-second price bars or candles. For all but the most active of intraday scalpers, a 1-minute period is short enough to understand the VWAP intraday. The longer the period of price data studied, the longer time frame you can get away with, but it is sometimes valuable to refer to the shorter time frame for a more accurate look at the true value. Active traders should start the day with a 1-minute time frame for the first part of the day, and then use longer time frames as the data gets scrunched up, and it becomes difficult to differentiate the candles. A shorter time frame slightly increases accuracy at new anchor points, but the longer time frames allow more clarity of the larger picture. Shorter-term time frame traders will be the participants who will benefit the most from the intraday charts. In considering where to set your anchor, the most common choices are to anchor from the open O, high H, low L, or close C. The most accurate AVWAP measurement will include as much data as possible, so the OLC4 is best, as it is the most inclusive of the data available. This simply means the weighting of the AVWAP will not be overly influenced by the open, high, low, or close. It treats them all equally. Is the AVWAP a moving average? When viewed on a chart, it is easy to confuse AVWAP with a traditional periodic or rolling time-weighted moving average. Time is part of the calculation of the AVWAP, but it is not the typical rolling time-based method used in the calculation of a moving average, where older data drops off and is replaced with newer data. The AVWAP is the cumulative average price, weighted by volume. The value of AVWAP changes with the continued addition of new price and volume data from the fixed starting point of our anchor. As time progresses, the amount of data builds cumulatively, and the AVWAP will move up or down. We can view this as a gauge of an emerging trend. The AVWAP is displayed as a line, and it moves up and down as time progresses. And while the AVWAP looks like a rolling period average price, the AVWAP is materially different and more valuable, because it starts at a significant event and builds with each new data point. Momentum and trend versus value. Like any indicator, the analysis of the AVWAP will have different applications to various market participants. A long momentum participant will view the positive slope of the AVWAP as confirmation that their position is working. When this occurs, they want to stay involved and possibly add to their position after pullbacks to the rising AVWAP. If the momentum holder observes prices below declining AVWAP, they will not want to take new positions and might consider a sale of their longs, or to even go short the stock. For an institutional trader who may take weeks to fill a large buy order, they are more concerned with price and value. They will be less aggressive about buying while the stock is above AVWAP and more aggressive while the stock is below AVWAP. Their job is to purchase the shares as close to or lower than AVWAP. They want to buy at discounts to the AVWAP to help improve the average price paid, speed, and lag. The amount of data used in any calculation of an average affects the rate of change of that calculation. I refer to this rate of change as speed. All averages become slower to respond when more data is brought into the equation. The number of data points increases throughout the period studied. This typically makes the indicator lag as we average more data. Unlike a moving average, the AVWAP does not always slow down with the addition of more time and data. The volume weighting makes it possible for the AVWAP to speed up as time progresses if there is an unusual surge in volume. Briefly summarizing, all averages suffer from some lag as the amount of data being averaged grows. The lag becomes more significant later in the relevant time period. New data points have diminished weight and will continue to have less weight as time progresses. The longer the period averaged, the smoother an average line will appear. With AVWAP, however, volume is the most important factor in the calculation, and a line displaying AVWAP will rapidly change shape, that is, speed up or down as volume surges. In Chart 5.6, notice how the VWAP speeds up as large volume spikes enter the market just after 1200 p.m. and 2 p.m. The VWAP/AVWAP is unique in that the average price can experience spikes with more volume, while a time-based average would have a smoother arc. Standard deviation and percent offset bands. Sometimes you will see standard deviation bands on a chart with AVWAP. See Chart 5.7. AVWAP bands are areas plotted at standard deviation levels above and below the AVWAP line. Percent offset bands are also used for the same purpose, except they will display at a fixed percentage above or below the AVWAP. Some people choose to display this additional information to identify areas where a stock is overbought or oversold. This information helps time their entries and exits based on historical volatility patterns. My preference is to not use any type of volatility band displayed over AVWAP. I prefer a cleaner look to the charts and to manage risk based on trends, not on mathematical tendencies. As with any analysis tool, if you find value in it, you should continue to use it. Do what works for you. Volume-weighted moving average, VWMA. Do not confuse a VWMA with the VWAP or AVWAP. A VWMA is a periodic, time-based moving average where more weight is given to bars with heavy volume and less emphasis on price points where less volume is traded. A VWMA is similar to VWAP and AVWAP in that it takes the volume of trading into consideration. The VMWA is fundamentally different from VWAP and AVWAP because it is a rolling average that continually drops off older data as it adds in newer data. VWMA is not a focus of this material because it is a rolling average. We are interested in the measurement of supply and demand forces from a specific time, not an average period. A rolling time-based average ruins our entire reason for anchoring from a specific point. Part 2, Using AVWAP. Chapter 1, Strategy Overview. The trend is your friend, Martin Zweig. Like many useful concepts, AVWAP is simple. It can be overcomplicated by people who try to be smarter than everyone else, rather than simply focus on making money in the markets. Do not confuse simple with ineffective. I wrote this book as an easy-to-understand manual on how to use this dynamic analysis tool for better stock selection, timing entries, risk management, and exit techniques. If you are interested in sifting through academic studies for further information about VWAP, you can find some of these studies in the bibliography. Trust me, some of them are dense. I hope you can profit from these strategies and use them to create and fine-tune strategies of your own. If you follow my work on Twitter at AlphaTrends, you know I never suggest anyone blindly buy or sell a stock just because someone else, including myself, suggested it as a buy or sell. If you buy a stock, it should mean you did your own analysis and you know where you will place your stop to limit losses if you are wrong. It is your money, so take responsibility for it. It doesn't matter where you find an idea. Once you put your money into it, it means that it makes sense to you and you must accept responsibility for the outcome. If you constantly ask others what they think you should do with your money, you probably shouldn't be trading. I hope this book will help you to become self-sufficient and make your own trade decisions. It is a great feeling to have the confidence in your analysis so that you can spend more time working on yourself, independent thinking and discipline, and your strategies than listening to the opinions of others. Note, this book uses a trend-following approach. Trend following is exactly as it sounds. We look to enter an established trend at a low risk point and hold the stock until the trend slows or reverses. In many of the strategy examples, we examine momentum trend trades. Remember these principles. Limit losses. Most of the examples in this book are trades that would have worked out. The lesson is to look for the right setups and then manage risk. The losing trades shown in this book, 5–10% of the total, will all have one thing in common: small losses. Losing trades are part of the business, and how you handle them can distinguish between success or failure in the markets. Focus on price. I often say, only price pays. People often misunderstand that statement and think I consider only price action and ignore all other information when I analyze a stock. Nothing could be further from the truth. The markets are an auction process, and prices alone tell us the price levels or ranges where business took place. Current price simply tells us the present value assigned by all market participants. Price alone does not reveal other significant pieces of the complicated market puzzle. At the end of the day, price is the scorecard. As my friend Jeff Cooper says, price is the final arbiter. Pay attention to multiple time frames. One of the biggest issues with many books about the market is that they are written with a single time frame dimension. They are all written for either investors, swing traders, or day traders. This material explains how to use the AVWAP regardless of your time frame. You will see examples for many time frames, and you will learn how to combine the time frames together, multiple time frame analysis, for better timing accuracy. Recognize that markets are fractal. We do not need to understand mathematics or geometry to recognize fractals. If we take the time to carefully observe and understand human nature and how stock market participants interact, we will see similar patterns in different markets and on various time frames. All the concepts of trend alignment and AVWAPs are transferable to other time frames because of the fractal nature of chart formations. The fractal nature of markets allows short-term traders to experience, on smaller time frames, what longer-term investors may take years to observe. This allows the shorter-term participant to learn market structure more rapidly. If you have a disdain for short-term trading, try to think of it as an opportunity to shorten your learning curve even if you do not participate in that time frame. Shorter-term traders should also learn how shorter-term trends fit together in a longer-term market move. This knowledge can help you hold your winners longer. Recognition of this fractal tendency is key to understanding why we can apply the same analysis techniques to completely different markets and on any time frame. We only need to learn the basics in one time frame, and we can apply those principles to all time frames. The most accurate price analysis comes from a recognition of the interplay of various time frames together for a more complete understanding of market structure. Don't get hung up on time frame. My personal preferred time frame in the market is from a few days to several weeks. Most of the examples will be that time frame. Please do not get hung up on the time frame shown on any of the charts. It is the concept that is most important. Many of the examples do not show the time frame because it is unnecessary to understand the point on the chart. You can be the smart money. We often hear that smart money is buying or selling some stock or doing something we should strive to do in the market. We are meant to feel inferior to this mysterious group of participants. Here is the truth. Smart money doesn't mean institutional money or a roomful of PhD tickets. It only means the group who controls the trend, meaning that they are on the correct side of the trend. It is a mix of institutions and retail traders, the same group that makes up the dumb money in the markets, the people on the wrong side of a trend. You can be the smart money if you understand market structure and use the best tools properly. AVWAP is one of the most important tools you need to understand to be in the smart money camp. Create your own process. At the 1969 Woodstock Festival, Jimi Hendrix performed what has become one of the most recognized versions of the Star-Spangled Banner. Jimi Hendrix most likely looked at the same sheet music that Francis Scott Key wrote 155 years earlier, but what Jimi played versus what Francis Scott wrote was much different. As an artist, Jimi made the song his own. This book is the sheet music for a market approach. You can try to play it note for note in the market and probably do well with it. If you really want to stand out and be a star in the markets, you will take this information for what I intended it to be, a guide. I wrote this book for you, as a market artist, to use as part of your method in the creation of a masterpiece of your own, your trading process. No one knows what will happen in the future. If we anticipate all potential outcomes, we will never be surprised and we will be ready for anything the market gives us. An unemotional plan allows us to prepare for all scenarios in case our primary thesis is proven wrong. Part of our trade plan needs to account for the times price action moves against our trade position. You must be able to objectively cut an unprofitable trade before it grows into a large loss that is more difficult to recover from. Work with momentum. The goal of momentum trades is to buy stocks as they rise, sell them when they look to have peaked, and to avoid the subsequent sell-off. If the trader can move from one winning stock to another, they can leverage time to keep their equity in stocks when trends are working to their advantage. Momentum trading is about buying high and selling higher. Of course, we know it doesn't mean that you should chase stocks that are moving higher, but rather to buy them as their momentum begins, so then we can manage risk properly. To emphasize concepts and not get hung up on the names of the companies, I have removed all the symbols from the charts. The names of market winners and losers will change with different market cycles. The laws of supply and demand do not. Chart 1.1 shows where low-risk momentum purchases are made green arrows as the stock regains upward price momentum. These purchases allow you to be in a position of strength from the start, rather than chasing prices higher, which increases risk levels. Put another way, if you wait to buy until the price exceeds breakout, prior high, you miss the upward momentum and risk the possibility that the new high fails and turns into the start of a downward trend. AVWAP subjectivity. Where to anchor the AVWAP is subjective. I try to remove some of that subjectivity with the use of concrete rules and examples. I packed this book with charts to reinforce the written word. After all, technical analysis is about charts. Remember, no tool can provide the most important ingredients for success: hard work, discipline with a willingness to be flexible, and risk management. That is up to you. The AVWAP is not a magic bullet, but it will amaze you how often the AVWAP from a specific event becomes the actual price turning point when there is little or no other technical data to indicate that change of trend should have occurred. My experience has convinced me that the AVWAP is the most powerful indicator. Whether you use it on a standalone basis for your analysis or as a complement to your current approach, I hope it is valuable to you too. No method of picking stocks is without flaw. Fundamental analysis or technical analysis will not assure success every time you put your money at risk. If you expect consistent success by analyzing fundamentals, fundamental analysis, you cannot buy stocks based solely on any one fundamental factor, such as a price-to-earnings ratio. Similarly, when using other forms of technical analysis, you need to consider more than a single historical trading pattern, such as a head and shoulder, to be a skilled trader. People who have learned to analyze a company based solely on its financial performance are often unfamiliar with, or unsuccessful at, technical analysis because they expect it to be formulaic. They confuse the art of interpretation and use of price study with the science of what they have read concerning cookie-cutter patterns. The strategies in this section are the ones that I have developed over my 30-plus years of trading and continue to use each day. They are not the only ways to use AVWAP. What about extended hours trading? This book is focused on the regular trading hours for U.S. equities, which are 9:30 a.m. to 4:00 p.m. Eastern Standard Time. The opportunity does exist to trade stocks in the pre-market as early as 8 a.m. and in the post-market as late as 8 p.m. For most stocks, volume is much lighter than in the regular trading hours, and that creates liquidity issues. Trades placed outside traditional trading hours have a unique set of risks, and as such, are not for everyone. There are times when the pre-market hours can get busy and large moves are often made in some stocks, which may be issuing earnings reports or reporting other news. I typically do not get involved in these stocks. I seldom enter new positions in the pre-market, but there are opportunities for those who are attracted to the very fast moves that can occur in these hours. That being said, if I am holding a stock, I do like to take profits when there are large moves in the pre-market. It is all about your personality and your preferences. Post-market moves are more common for the stocks of bigger companies, especially during earnings season when many companies report their quarterly results after the 4 p.m. close. This can affect some of the largest stocks in existence, and the trading can be very liquid and volatile. If you are prone to chasing stocks or unable to control your emotional urges, it will be difficult for you to trade successfully in the extended hours. Only you will know if it makes sense for your personality to trade during the extended hours sessions. Until you know, keep your share size small in extended trade hours. Chapter 2. Support and Resistance. Never turn a trade into an investment or an investment into a trade. Barry Ritholtz. Chapter Objectives. 1. Define support and identify levels of support on a chart. 2. Understand support as a level of demand. 3. Define resistance and identify levels of resistance on a chart. 4. Understand resistance as a level of supply. 5. Identify levels of interest on a chart. 6. Use AVWAP to analyze levels of support and resistance. 7. Use AVWAP slope to determine if buyers or sellers are in control of the action. The continual struggle for control between the bulls and bears makes the stock market a fascinating study of the basic laws of supply and demand. Support and resistance levels are where we understand how markets move. The goal of a trader is to study how a stock reacts to the ever-present supply and demand battles. When a trend exerts strength, in either direction, we must be ready to be on the correct side so we can take part in the directional moves that follow. AVWAPs can reveal order in the market where none appears from traditional technical analysis tools. This is how I first recognized the value of the AVWAP when I noticed it in 2003. If you do not use AVWAP in your analysis, you cannot see important levels of support and resistance that others are using successfully to make more money. The simplest and most effective use of the AVWAP is to find hidden levels of support and resistance. How do they hide? The answer is simple. You can't see them if you don't place the AVWAP on the chart. Once we identify support and resistance with the AVWAP, then we can use those levels as the basis of our trade plan. When we buy or sell a stock as it emerges from the battlegrounds of support and resistance levels, we can also control risk easily and objectively by placing stops outside of the consolidation range after our entry into a new position. Therefore, it is essential to understand the concepts of support and resistance in order to identify where to place the stop. What is support? Support in the markets, or an individual stock, is an area where prices drop and there is enough buying interest demand to overwhelm selling supply, and prices level out where they find support. Look at the thick green line in chart 2.1. Temporary price equilibrium after a pullback is known as support. This is a price range rather than a precise price point. This tendency reveals itself more in longer time frames, where ranges are typically larger. Support areas form as various participants feel compelled to buy in the same approximate area. The stock becomes more neutral or trendless as it builds up enough pent-up energy from buyers and sellers for the next trend to emerge. During a transition from a market controlled by supply to control by demand, sellers become less aggressive and buyers become more assertive with their bids. For example, participants with an open short position can be motivated to buy back their positions profitably. Long holders who want to add to their positions perceive value, which induces them to place bids. This level of value at support might also motivate sidelined cash to get involved. The collective action of participants at these price levels results in less supply and more demand, which halts downward price activity and provides support for the stock. This is why you should think of support as a demand area. What is resistance? Similar to support, resistance is not a precise level, it is an area. It is common for support and resistance to form a loose range. Think of resistance as an area of supply. Resistance levels halt an upward price move, at least temporarily, and is the opposite of support. At resistance, sellers provide enough pressure supply to overwhelm the buying demand and prices resist going higher. Buyers become less aggressive, and sellers become more aggressive. The formation of resistance is a transition from a demand-controlled market to a supply-controlled market, shown with the thick red line on chart 2.2. Resistance levels can be areas where three things occur: longs will exit, buyers will slow their purchases, and shorts will consider entry. Do we use support and resistance? Potential. Add this word to your vocabulary. You will often read phrases like, the market has supported XXX. Most of the time, XXX refers to a price area below where the current price resides. It is also common to hear this about a prior level of resistance. There is strong resistance at XXX. The resistance levels refer to areas of prior price consolidation areas above current price levels. No one knows where true support and resistance lie until after the fact. Until a stock bounces from a prior consolidation area, the short-term consolidation is simply a potential support or resistance level. I like to call them a level of interest. Stocks often continue along their current trajectory longer than people expect and through a perceived level of support or resistance. This can confuse participants who try to time a reversal. There are two phrases to remember if you get burned with an entry at unproven support and resistance levels. Fear knows no support. Greed knows no resistance. Market psychology. Levels of interest. It is best to not consider a potential level of support or resistance to be an automatic place to do business, but rather an area where you should look for evidence that confirms or refutes your thesis. Do we find evidence? Examine the level of interest on a shorter-term time frame and look for a price area where you expect something will happen, typically a reversal or breakout. This is the cornerstone of the concept of multiple time frame analysis. Gather evidence, observe objectively, and patiently wait for the trade opportunity to reveal itself in a low-risk way before you commit your hard-earned money to a risk position. Every television detective says a criminal always returns to the scene of the crime. This is often true in the markets, which will often revisit and test the prior consolidation, support, or resistance zone. When we look for a prior level of interest to become support or resistance, what we really look for is for that area to transform into an area where price is re-evaluated by enough participants to become a place where we can make a low-risk, high-probability entry. You only want to make a stock purchase once you have actual evidence of buyers stepping in and regaining control. Never buy blindly at a level on the chart. Our mission is to anticipate areas, levels of interest, where the buying or selling may become significant enough to halt a price advance resistance or halt a decline support. After we identify levels of interest, some people place a bid in that area and hope it does, in fact, become support. My preference is to use that area as a place to drill down the analysis to a shorter time frame to look for actual evidence that the buyers are gaining control. Don't buy the dip, buy strength after the dip. Once that evidence is present, the next step is to plan a trade based on the perceived risk relative to the reward potential. The focus should always be risk management to assure any loss taken is small. Notice the direction of the AVWAP is more important than an occasional piercing of the AVWAP. One of these charts is constructed of daily data and the other with 15-minute data. Regardless of time frame, the principles are the same. How does AVWAP play into support and resistance? The AVWAP helps us to determine how the market digests a price move. Whether the market accepts or rejects new price activity from the onset of a new trend, and momentum traders want to be buyers when the AVWAP is increasing, and want to be sellers when AVWAP is decreasing. A trending market, prices stay above an upsloping AVWAP, and in a decline, prices stay below a descending AVWAP. Chart 2.5 shows buyers in control above the AVWAP and sellers in control below it. If buyers show up on pullbacks to a rising AVWAP 1, on chart 2.5, there is a continued appetite for the stock, which makes it more likely the stock will continue higher. Those are the stocks we want to own. When prices drop below AVWAP 2, it reveals less demand, and we do not want to make new purchases. The lack of support for the stock also tells us to be on our guard for potential reversals, and we should shift from considering new purchases to managing our risks on any open position. Let's first look at an example of support and resistance with VWAP for 1 day. Please note, the same concepts apply to all time frames. When the stock is in a trend day, that is, trending up or down during a day, it is likely to finish near the high, long, or low short of the day. Two examples in charts 2.6 and 2.7 show 1-minute charts for 1 day. The chart on the left shows price action alone, and the one on the right shows price along with the daily VWAP, which starts from the first minute of trading. A trader can observe support and resistance at VWAP/AVWAP levels in all time frames, from the shortest intraday charts to multiple years. The only difference between the two charts is the addition of the daily VWAP to the one on the right. The stock gapped higher one and immediately found supply from sellers. This drove the price lower too. After the first few minutes of trading, the buyers regained control as the stock traded back above the daily VWAP 3 just before 10 a.m. This early shakeout action often precedes a continuation of the direction of the original gap. Notice how 2 subsequent tests of the VWAP also found demand support from buyers 4 and 5. There are no other technical tools which would have led you to think buyers would emerge where the 2 blue arrows are located. Without an understanding of the proper use of the VWAP, you would never be able to see that. In fact, there is a trend upward over the relevant time frame. Without the VWAP, you would think that the price was entering a downward trend when the tool shows that it is more likely that buyers will be upping their purchases 4 and 5. The VWAP and AVWAP can reveal important levels of buyer and seller interest, which do not show with any other analysis method. In the charts above, we see how the addition of VWAP to the chart can show us hidden levels of resistance. Chart 2.8 shows price action only, while chart 2.9 shows price along with the daily VWAP. Notice how the stock gapped lower on the day 1 and stayed below the declining VWAP throughout the session. When the slope of the VWAP is lower, it is best to stay away from the long side, that is, not to buy or hold on to shares. In fact, with the example above, it would have made sense to short the stock just before 1045 a.m. when it rallied to the declining VWAP2 and then resumed its decline. Without the VWAP, it would have been much more difficult to identify where resistance might be found. The development of the VWAP showed an objective measure of trend activity to compare price to as it unfolds. Market psychology, support, and resistance consider support and resistance areas as places where a bounce might occur, but look for other confirmations before making a purchase. Our job is to anticipate price scenarios, not predict them. Once we identify a key level of support or resistance, we wait for price confirmation. Prices begin to move higher on a shorter time frame before putting hard-earned money to risk. We want to be involved in an emerging move at the onset, not after a trend campaign is well underway and the risks are higher. Do not chase price action. If you miss out, it exposes you to too much risk. Be aware that the more obvious a level seems to be, the more likely it is that other traders will also know that level, and they will use it as an area for a stop loss or to exit a portion of their position. This can make the obvious level a place where failed moves are likely, so be careful with stops in these areas. We want to anticipate whether a price zone will be a level where a breakout or reversal is likely to occur. Do that we try to understand at what price zone enough participants will get involved to shift the balance of supply and demand. The AVWAP allows us the ability to better find this potential price zone because it allows us to compare the instantaneous prices with the trending price. When you identify potential levels of support and resistance, consider: where will longs be forced to fearfully liquidate before they sustain a larger loss? Where will short sellers become nervous about growing losses and become motivated to cover their bearish bets? This could lead to a short squeeze. Where will sideline cash be unable to resist getting involved? Market psychology, self-reinforcing role. The natural question is, why do certain price areas attract enough buyers and sellers to provide support or resistance to price movement? Support and resistance areas are often self-fulfilling in nature. When you first learn about technical analysis, you likely heard something like, the bulls live above the 50-day moving average DMA and bears live below the 50 DMA. Well, guess what? Countless market participants share this rule of thumb. If enough of them believe it to be true, they will perceive a value opportunity as a stock pulls back towards the 50 DMA, and it will play out in this way. For example, short sellers who may have sold higher as the stock was extended, stretched far above the 50 DMA, stop selling and may buy to cover their bets at this perceived level of value. Institutions that own a lot of the stock will sell some of it as it becomes extended from the 50 DMA in order to reduce their position, and then rebid for those shares at lower prices as the stock drops back down toward the 50 DMA. This allows them to sell some shares at high prices relative to the 50 DMA and replace them at cheaper prices. As they replace the quantity of shares they sold at higher at the prices with shares at the now lower prices, this could help to create support at the 50 DMA. The stability from their purchases encourages others to participate at the 50 DMA, which helps further strengthen support. Holders of cash who are standing on the sidelines might now come in to purchase the stock at what they believe to be a bargain price. The collective action of these participants results in diminished supply and increased demand. That is how support gets formed. In the charts below, the emphasis is on the direction of the significant moving averages. For charts 2.10 and 2.11, the daily chart on the left shows a stock in an uptrend, but note that the price drops below the 50 DMA twice. This shows that the 50 DMA is an area of interest for further study, not necessarily a point where you should automatically buy or sell. Likewise, the chart on the right shows the declining 50 DMA as a reason not to trust rally attempts in a downtrend. As we will see later, we will make a shorter-term analysis using the 5 DMA in the same way. Of course, the 50 DMA is just one example of where and how a price level may attract enough activity to bring about a shift in supply and demand, and create a level of support or resistance. Supply and demand battles for control of a trend can, and often do, occur at other levels of technical significance you may be familiar with, such as Fibonacci retracement or extension levels, a prior consolidation area, or widely watched moving averages. Our focus here is AVWAP, which complements all the other analysis techniques. It is also important to recognize that if one or more other technical factors show up in the same general area, it can reinforce that area's level of significance because more participants may be forming their decision to buy, sell, or stand aside in the same area, but each for different reasons. The more people coming to the same price conclusion, in the same area increases the likelihood it will become support or resistance. How would you feel? Beyond mere recognition of support and resistance zones, true market understanding comes from anticipation of how other participants will act in different scenarios. When you look at a chart, try to imagine how you would feel and possibly act if you were long, short, or in cash. If support breaks, who will buy, sell, or cover? How about when resistance is broken? Understand the psychology of why support and resistance develop, and you will have a significant advantage over most participants who simply look at patterns. Going deeper, slope of the AVWAP. One of the most common questions about the volume of trading activity is whether the volume was in buying or selling. Well, of course, it is both. For every buyer, there is a seller and vice versa. What we really want to know is who is more aggressive and who is in control, the buyers or sellers. Direction and slope of the AVWAP allows us to answer that question easily and accurately. AVWAP allows us to quantify who has control at any point, buyers or sellers. The chart 2.12 demonstrates how to determine the directional bias by the slope of the AVWAP. The slope of AVWAP, higher or lower, shows whether the dollar average paid per share for the period studied is rising or declining. When the slope rises, buyers are in control from the anchor point. When the direction of the AVWAP is lower, we know sellers are in control from the anchor point. The direction and rate of change of the AVWAP is often more important than simply being above or below it. The steeper the slope of AVWAP, the more aggressive the trend and higher the likelihood the AVWAP will act as support on pullbacks, and the stock will experience a bounce. The AVWAP can be the reason support is found as sellers become less aggressive and buyers place bids closer to fair value. The AVWAP becomes and reinforces support levels. The reverse of this takes place when the trend is in the other direction. The AVWAP becomes and reinforces resistance levels as sellers become more aggressive relative to buyers. We see this below in chart 2.12. As the slope of the AVWAP flattens out, it shows that there is greater market acceptance of the value, and the market likely needs more time and perhaps a price shakeout before the original trend resumes. When a flat AVWAP gets tested more frequently, it is more likely to flip from support to resistance and resistance to support. The goal is to use that information to identify low-risk, high-probability trades. Rising AVWAP. A stock with a rising AVWAP shows that buyers are more aggressive than sellers during the time frame in question. The market must rotate to higher prices in search of liquidity supply to satisfy the quantity of buy orders demand. In chart 2.13, we set the anchor to the gap on the 27th on this 65-minute time frame. 1. Notice how the AVWAP provided support, green arrows, as buyers stepped up their purchases near the AVWAP on the pullbacks in its uptrend. Chart 2.14 emphasizes why one should not automatically change from bullish to bearish on a short-term break of the VWAP-AVWAP. As evidence that the market is reversing in advance, the direction of the VWAP will typically flatten out, prices will cross below, get trapped under the VWAP, and then decline. Earlier in the day, or during whatever the time frame being studied, the slope of the VWAP is typically at its most extreme level because the number of data periods being averaged is lower. As the day progresses, and each transaction has less impact on the average, it is natural to see the slope of the VWAP become less pronounced. General note, all moving averages should be used as a reference point to compare price trends. They should not be considered as automatic levels to do business when they are touched, but as a reason to observe the price action on a shorter-term time frame where we formulate a plan. Generally give the benefit of doubt to buyers when the 50 DMA trend is higher and to sellers when the slope is lower. Takeaways on rising AVWAP. When the direction of the AVWAP is trending higher, we should have a long bias and avoid new short positions. The increase in price shows on the chart as a bullish trend above the rising AVWAP. Consider these stocks innocent until proven guilty during the time frame that this occurs. Buyers should seek opportunities to buy after pullbacks toward the AVWAP, but first wait for evidence of actual support. If there is, then prices will likely rise, and we have a logical place for our stop. The first one or two touches of an important AVWAP are more likely to experience a strong bounce. This tendency occurs as sidelined buyers who thought they missed the move rush in to purchase shares. As the life of the trend stretches out, the bounces occur with less enthusiasm, which raises our level of caution and our defensive posture. When a bounce is less vigorous, it's because buyers are a less motivated source of demand, thus, the trend more vulnerable to failure. As with any level of support, the more times and more frequently support gets tested without a bounce away from the AVWAP, the more likely it is to fail in the near term. Declining AVWAP. When a stock is below a declining AVWAP, it tells us that sellers are more motivated than buyers. Transactions occur at lower prices, which show on a chart as a bearish trend below the declining AVWAP. In a decline, the market does not accept the supply at current levels, so prices fall to levels where there is sufficient demand to absorb the supply. When the AVWAP is in a downtrend, the stance to take is a short bias and use caution on open long positions. Consider these stocks guilty until proven innocent on the time frame where this occurs. If you have a long position that you want to get out of, rallies up to the AVWAP are often an excellent point to exit before the stock heads back lower. If you want to enter a short position, you can start new positions as prices fall away from the declining AVWAP, with a stop above the most recent and relevant lower high for your time frame. Chart 2.15 shows how sellers will provide resistance at a declining AVWAP. We set the initial anchor to the start of the large move lower, which began near $60 per share. 1. Notice how the sellers showed up on the touches of the AVWAP, red arrows at 3, 5, 7, and 9, as the prices continued their decline. Sellers have picked up momentum after tests of the AVWAP from $60. 1. When prices fall away from the declining AVWAP, we sell short green circles in expectation that the trend will continue lower. If the stock reverses back up through the AVWAP, we want to have a stop in place to minimize any loss. This stop is placed above the recent lower high, represented with red arrows, 35.79. For instance, if we sell 2, our stop would go above the previous high 3, and so on as the stock continues its decline. It's common for large institutions to set multi-week AVWAP programs at the start of an event. Those programs become more aggressive as prices approach the AVWAP from the start of the event and provide overwhelming supply which forms resistance. The daily VWAP is shown on chart 2.16. When the direction of the VWAP is lower, be careful not to get bullish on the first crossing of price above the VWAP blue circle. For the market to reverse a decline, the direction of the VWAP will first flatten out, prices will cross above and then stay above the VWAP. Takeaways on declining AVWAP. When the direction of the AVWAP is lower, we should have a bias towards short positions and avoid new long positions. The decrease in prices appears on the chart as a bearish trend below the declining AVWAP. Consider these stocks guilty until proven innocent on the time frame this occurs. Short sellers should seek opportunities to sell after the price rallies up to the AVWAP, finds resistance, and then falls. The first 1 or 2 touches of an important AVWAP are more likely to experience a quick sell-off, which makes them great candidates for a short sale. As the life of the trend stretches out, the declines occur with less vigor, which raises our level of caution and our defensive posture towards new short sales. As with any level of resistance, the more times and more frequently resistance gets tested without a decline in price, the more likely it is to fail in the near term. Oscillate above and below AVWAP. When you observe a flat AVWAP with prices crossing above and below it, my advice is to avoid the stock on that time frame. This action is neutral and there is no edge in being long or short. Rather than complain about choppy action or lack of opportunity, we should interpret the message of the market as meaning one of 3 things to us. Cash is a good position for now. Find another market or stock to trade, or switch to a different time frame to find a better opportunity to get involved. It is good to recognize these stocks. The lack of current opportunity frees up our time to focus on more actionable setups. Chart 2.17 shows multiple crosses above and below the AVWAP. In Chart 2.17, we anchored the AVWAP to an important low 1 on the stock above. Initially, the buyers regained control too, but as the stock traded above and below the AVWAP 3, the stock needed more time to let the buyers and sellers battle it out for control. Trend traders should avoid these stocks until there is greater clarity of who has control. Once again, it is important to realize that these concepts are the same for stocks of all prices and on all time frames. Do not focus on the price or the specific time frame on any of the charts shown. Market psychology, institution's role. For an institutional trader who wants to buy a large amount of a stock in an uptrend, it makes sense to place bids for the stock as it pulls back down to AVWAP, since it is an opportunity for them to scoop up shares at the fair value relative to the open and the price they might expect it to close. Risk management. When we anticipate a level of interest which has the potential to become support or resistance, it becomes our job to observe that area on a shorter time frame for evidence of whether it is the buyers or sellers that are gaining control. The lowest risk trades are the ones where we have a clear plan in advance. A clear plan anticipates an area of transition where we observe the action on a shorter-term timeframe before we get involved. Some of the most common trade mistakes occur from reactive FOMO decisions. Key takeaways. The concepts of support and resistance apply to all timeframes. AVWAPs can reveal order in the market that traditional technical analysis tools cannot. The simplest and most effective use of the AVWAP is to find hidden levels of support and resistance. Unlike the more common support and resistance levels, which are seen as horizontal price consolidations, the support and resistance levels of an AVWAP are dynamic. They adjust with each trade. AVWAP allows us to quantify who has control from any point, buyers or sellers. The slope of the AVWAP easily identifies directional momentum. When it rises, buyers are in control from the start of the anchor. Inversely, if the slope falls, sellers are in control from the start of the anchor. Support and resistance areas have a self-reinforcing role, which makes the psychology of the participants' motivations important to understand. We only know support and resistance levels in hindsight. They are levels of interest until confirmed by subsequent price action. Don't buy the dip, buy strength after the dip. Chapter 3. VWAP Entry and Exit Techniques. You've got to know when to hold 'em, know when to fold 'em, know when to walk away, and know when to run. Kenny Rogers. Chapter Objectives. 1. Understand two options for entry. A. Option A, buy the touch of a VWAP. B. Option B, buy strength or sell short after the touch momentum. 2. How to decide which entry is correct for you. 3. Understand how support becomes resistance and vice versa. 4. Understand support and resistance failures and how to trade on these reversals. Traders should use the VWAP's ability to identify levels of support or resistance to their advantage. One way to do that is to wait for a test of an VWAP level and to purchase the stock on the first touch of the VWAP and hope that it holds. The other option is to observe the action around the VWAP and treat it as a level of interest on a shorter time frame. If your choice is to observe, the next step is to wait for evidence that the buyers are serious about their actions and will defend VWAP. Once it is clear the stock has found support or resistance at the VWAP, we can enter the stock and place a stop. Now we will explore both options in more detail. Option A, buy the touch. Purchase or sell short, just as the stock touches VWAP. This is not my preference as I am more risk-averse, and there is no assurance the stock will bounce from the VWAP. Paul Levine, PhD, was a pioneer in VWAP analysis and gave the term porosity to describe how VWAPs are general areas, not precise numbers. That said, there are times when a stock will touch the VWAP to the penny and reverse immediately. When a stock is far beyond the VWAP 0.2 in chart 3.1, I view this intuitively, while others may use standard deviation bands. Chart 3.0 shows the VWAP as well as standard deviation bands. As always, any trade setup is more likely to be successful when trends are aligned with longer time frames of the stock and the trend of the overall market. If you buy at each touch of a VWAP, it is sometimes possible to purchase at the exact turning point, but you run the risk the stock may continue lower. 0.4 in chart 3.1. If the stock does not bounce from the VWAP, it's difficult to find a price-based level for your stop because there is often a lack of a lower high nearby to place the stop under. The stock in chart 3.1 made an important near-term low on October 24th. That is where we set our anchor. Note that large distance between price and the VWAP 2. When prices extend far from the VWAP, new purchases are considered to be riskier. On November 2, the stock pulled back to the VWAP 3 from that low and bounced precisely from that level. 2 days later, the stock came back to the VWAP 4 and this time failed to bounce. This example shows one instance where the trader would have made money immediately if he purchased the touch of the VWAP 3. It also shows where the stock continued to decline through the VWAP, which would have resulted in a loss 4. VWAP levels are not always an automatic place to do business, and you must decide through trial and error if you prefer to buy the touch or wait for the stock to bounce from the VWAP before you make a purchase. I cover this at length in Chapter 7, Buy Pullbacks and Breakouts. Stock in chart 3.2 continued in its uptrend from the early February anchor point, but the purchases right at the VWAP green arrows from the low didn't all immediately result in a gain. It can be better to purchase when the stock rises again, the bounce. The green dots show these points. When we purchase with momentum, we take part as the new trend begins. We can place a stop below the preceding higher low to protect us in the event that the price action does not follow through. A purchase right at the AVWAP touch does not allow us to have a consistent low-risk stop level based on price action. Option B, enter with momentum. Purchasing the stock after it tests the AVWAP and bounces away from it is the lower-risk entry. A short sale after a test of a VWAP followed by a decline is the lower-risk short entry. In this type of setup, we have evidence that buyers have defended the AVWAP successfully before we put our money at risk. Momentum is on our side with these entries, long and short. The AVWAP allows us to find exactly where and when the sellers are overwhelmed and buyers have regained control. This type of entry allows us to enter at the onset of new momentum and easily define our risk. I like to be right from the start and enter a trade with momentum. Let others jump the gun, do the dirty work, and take the larger associated risks while support forms. If you are in the right neighborhood, there will still be plenty of opportunity for profit and with less risk. Wait patiently for the signal. A general guideline would be 3-5 bars for the time frame you are on to enter so you have a level to trade against. We want to enter after buyers or sellers have regained control, by strength after the dip and short weakness after the rip. In chart 3.3, the stock made an important high in early January. Once the stock dropped for a few days, that high became the logical place to set our AVWAP, blue arrow. There were several touches of the AVWAP, red arrows, where the stock could have been shorted with minimal initial loss, and that makes it tempting to short at the AVWAP. With the benefit of hindsight, we know these trades would have been profitable. But at that moment, when these trades might have been initiated, the momentum and stop placement price was not clear. That makes these entries risky. The other option is to wait for the stock to drop away from the AVWAP and short as the downward momentum builds green dots. We could then place a stop above the preceding high red arrows. This latter entry point assures the stock is moving in the desired direction before our entry. It also provides us with an easily identifiable level for our stop loss in case the stock reverses back higher. In chart 3.4, we can see how selling short as the stock touches AVWAP red arrows would have resulted in choppy trading or, worse, losses. As noted, I prefer to start a short position as the stock drops away from the AVWAP, indicated by the green dots, where the downward momentum is confirmed. Then we can place a stop above the most recent relevant lower high. When you set your stop level based on price action, it allows for greater certainty and confidence in the trade from the start. Which is right for you. There is no one right way for everything, only the right way for you. Whether you decide your approach is to buy just as the stock touches the AVWAP, or if you wait for further evidence before you make an entry. Most people will gravitate toward one or the other. You might have a natural preference about the entry location, or it might take time to develop your preference as you try both methods. Some people might even prefer to take a hybrid approach, where they start their position on the first touch of the AVWAP, and then add to the position after it proves to be momentum support or resistance. As always, do what is right for you. Make the trade your own. Market psychology, price has memory, so use it. One of the basic tenets of the study of price history is that broken support acts as resistance. The opposite is also true. Broken resistance acts as support. Support becomes resistance. Have you ever purchased a stock, watched it decline in price, and wish you could just get out at break-even? Me too. This type of buyer's remorse shows up on a chart as resistance. When the stock rallies back to the purchase price and you place your sell order, it adds supply, which becomes a block, however temporary, to the price advancement. Obviously, one person's sale of stock won't typically offer much resistance. When sales occur at a widely recognized level, price memory, shared by many participants, such as a significant moving average or average of a VWAP level, it becomes much harder for the stock to work through the large supply being offered before it can move higher. Don't forget about short sellers here too. When support breaks, short sellers are in control of the stock, and they will try to defend their short position by adding more supply in hopes of not only adding to their short position, but also to scare long holders to liquidate their positions in fear of larger losses, which benefits their short bet. Notice that in chart 3.5 there were no actual tests of the rising AVWAP. This is an example of a non-textbook example. We often give analysis of a VWAP or any market approach an improbable expectation of success. In real trading, it isn't as perfect as some books would lead you to believe. Remember, there is the science of analysis and the more difficult art of trading. Chart 3.6 is a more straightforward example of how the AVWAP, which once provided support, green arrows, became resistance, red arrows. Chart 3.7, the AVWAP from the October low blue arrow on left showed support twice 1 and 2 before it flipped to resistance in early January 3, and then again in early February 4. If you find me on Twitter in a situation like this, you might hear me refer to points 3 and 4 as AVWAP tap and crap or AVWAP thump and dump. And the green AVWAP is anchored from the January low, 5. Notice how the AVWAP acted as resistance twice after the start of the decline, 6 in early February and 7 in mid-February. We use price charts to understand the collective reasoning and psychology of market participants so we can objectively prepare our trade plan. When traditional support breaks and then acts as resistance, it means that there has been a greater number of participants anchored at that price level, which in turn can lead to a larger opposite move when the price breaks. When price breaks a major level of support, the trapped longs will have a propensity to get out at break-even, and as they sell shares, the supply from these participants helps to form resistance. Resistance becomes support. The same emotions come into play when a stock forms support on a chart. Have you ever sold a stock after it has done nothing for months, and then see it almost immediately turn higher without you? It is as if they know you are out and agree to take the stock higher without you. Of course, this doesn't really happen, but you probably wish you could buy your shares back at your original cost. As sellers start to take advantage of the rising price, causing the stock to pull back toward the breakout level, you may decide to get back in. Others, with sidelined cash, may also be motivated to join in on what appears to be a new uptrend. Don't forget about those short sellers. If you were shorting the stock and it breaks out, it may motivate you to purchase your stock on the pullback before it begins a move higher. These short covering purchases are strictly about limiting losses, which can quickly spiral out of control if the stock follows through on the breakout. These actions, repeated by many buyers and sellers, form support for a stock's price. Charts 3.8 and 3.9 show traditional horizontal resistance versus AVWAP support and resistance, with 3.8 as traditional and 3.9 as AVWAP. The AVWAP provides dynamic evidence of support and resistance. Chart 3.8 shows what has been referred to as horizontal or traditional support, green, becoming resistance, red. Chart 3.9 shows the AVWAP from a former peak becomes support after the stock makes it back up above that prior resistance. Both techniques of measuring support and resistance are valuable, but by using AVWAP, pricing activity is revealed to be more granular, and you can see subtle changes in trends. This makes it easier for you to more precisely time a purchase or sale. Charts 3.10 and 3.11 also illustrate the differences of the two methods of finding levels of support and resistance. Active traders who use traditional measures of support would miss a number of opportunities to buy or sell. For example, based on what you've read so far, can you see in chart 3.11 where the two green arrows show areas of interest for setting up trades? These areas are not so easily identified in chart 3.10. By using AVWAP, traders can see the transition from support to resistance more quickly and precisely. The more times support or resistance is tested, the more likely it is to fail. This is a simple but important concept. Traders' impatience is demonstrated by the frequency of tests made to support and resistance. Monitor this impatience carefully for signs of potential for the price to move out of the current range. Price level breakouts may trigger an important turn in the trading activity of the average participant, and as we will see, they are excellent places from which to anchor our AVWAP. When traditional resistance breaks and then acts as support, larger moves often occur on the upside. When prices break a major level of resistance, the trapped shorts will look to get out at break even by purchasing shares to cover their positions, and the demand from these participants helps to form support. Two charts below show the concept of how broken resistance becomes support. I came up with a couple of corny ways to remember them: AVWAP kiss and run, or AVWAP tap and snap. Chart 3.12 shows two instances where resistance provided by the AVWAPs anchored to separate points broke 12, and then flipped to support 34 over the course of just 4 days. In chart 3.13, the daily chart saw the AVWAP from the early peak act as resistance, red arrows, before buyers took control, and then defended pullbacks to the AVWAP, where it formed support, green arrows. Eventually, the buyers soaked up all the supply offered, and the stock experienced a great run higher. In the two charts on page 77, we see the same concepts on different timeframes for further reinforcement. The stock in charts 3.14 and 3.15 show two different timeframes of the same stock where broken AVWAP resistance became support. Chart 3.14 shows 2.5 months of trades, while chart 3.15 shows 6 weeks of trades on a 65-minute timeframe. The repetition of the pattern on different timeframes is a great example of a fractal playing out with support and resistance. Longer a consolidation zone period of relative stability in price has taken time to develop, the greater the move away from it will be as more energy has built up. There is a larger group of traders who will benefit from a momentum push away from the consolidation. A good way to remember this is, the bigger the top, the bigger the drop, and the bigger the base, the higher in space. We will delve more into market structure and trends, which are formed by directional support and resistance zones, key levels and price targets. When we purchase a stock, it is good to know where it has the potential to go, and an AVWAP from a prior important peak will often become resistance for the stock. When a stock makes a large move, and there are no levels of traditional support or resistance to be found on the chart, except for the AVWAP, it is a good idea to look at prior important highs and lows as anchor points. It is uncanny how often you will see a stock halt at an AVWAP from a prior high or low. Knowledge of these levels in advance allow us to approximate a target for the price move. Price targets are not necessarily a place to take profit, but to manage risk with tighter stops, so that if the stock does reverse, we can lock in large gains. If you bought this stock, 3.16, based on your analysis of shorter timeframes, it would have been wise to be aware of where the AVWAP lies in relation to the peak's green dots. The stock made two quick moves up to the AVWAP and then came back down. This is a common occurrence in stocks that experience a bounce up toward the AVWAP. When a stock in a longer uptrend experiences a large drop, traders will often start buying when the price drops to the AVWAP anchored at an important prior lower price, as seen in chart 3.17. A place for a short seller to lock in a profit would have been at the green dot, which is where the price met the purple AVWAP. This had been set from a prior important low and would have been a reasonable place for a bounce in price. Going deeper, support and resistance failure. Support and resistance levels are not concrete, they are not guaranteed to hold. Eventually the tone of the market will change from bullish to bearish and vice versa. When key support and resistance levels break, be ready to act to protect your accumulated gains because large moves in the opposite direction can come quickly. The next four charts illustrate two bullish, 3.18 and 3.19, and two bearish, 3.20 and 3.21 examples. Charts 3.18 and 3.19 show stocks which repetitively tested the AVWAP from the prior significant low before the trend reversed lower. As the stocks experienced decent rallies, the rate of ascent in the AVWAP slowed, resulting in even more frequent market testing of the AVWAPs. Prices eventually broke the AVWAP support and began quick declines. Recognition of this tendency will allow you to exit winners with the bulk of your profits intact before reversals take place. For more aggressive traders, the drop away from AVWAP can also provide an early entry into a reversal. Two stocks in charts 3.20 and 3.21 were in downtrends and consistently found sellers at the AVWAP's red arrows, which were anchored to the significant high prior to the decline. As the stocks declined further, the AVWAPs were tested repeatedly, which eventually overwhelmed sellers, and the stock reversed to an upward trend. Repeated tests of a VWAP chewed through supply as the persistent buyers became more aggressive. You can use the concepts of a VWAP support and resistance on a standalone basis for a trade system, and you will probably achieve positive results. Of course, you also must manage risk effectively. Do not confuse simple with ineffective. All too many people want a complicated approach, but simplicity is the market's greatest disguise. After all, stock prices move because of supply and demand. We don't have to be obsessed with the why behind the moves. Strategies in the chapters ahead will assume you have read and understand the concepts discussed here. They are the building blocks of the layers we add on top of basic support and resistance. Risk management. It can be difficult to wait patiently for conditions to develop into your ideal time to make a trade and to resist the temptation to get involved early. Too many times, traders give in to FOMO and buy before AVWAP provides evidence confirming who has regained control. Thus, they suffer needless losses. For longer than I care to admit, this was a problem for me. I would be sure a stock was ready to go, so I would get involved before the price action confirmed momentum. Once in a while, I would get lucky on this type of entry, but over the long term, these trades ended up costing me money. Key takeaways. AVWAP support often becomes resistance once it is broken. AVWAP resistance often becomes support once it is broken. Key AVWAP levels can indicate where the stock may lose momentum. Do not confuse simple with ineffective. Too many people want a complicated approach, but simplicity is the market's greatest disguise. The more times AVWAP support or resistance is tested, the more likely it is to fail. Chapter 4. Where to set the anchor. Art is more godlike than science. Science discovers, art creates. John Opie, Chapter Objectives. 1. Where to anchor in high-volume events more than 1.5x normal. 2. Place anchors at measurable events. A. Fundamental events. B. Price-based events. C. Time-based events. 3. Anchoring to fundamental events, including news. A. Earnings reports. B. Federal Reserve announcement. 4. Anchoring to price-based events. A. When price is the news. B. Using price-based anchors. 5. Anchoring to specific time-based events. A. Week-to-date. B. Month-to-date. C. Quarter-to-date. D. Year-to-date. 6. The anchored VWAP handoff and pinch. 7. Market psychology, the art of anchoring. The goal of this chapter is to identify the most valuable places to set the anchor. With that, we can measure supply and demand forces objectively and gain an edge in our buy and sell decisions. When we begin our VWAP measurement from any point other than the beginning of one day, it becomes an anchored VWAP, AVWAP, and it is cumulative from that point forward. Our interpretation of price action is relative to the direction and slope of the AVWAP. The concepts introduced in this chapter are the basis of the strategy chapters that follow. As always, the time frame shown on the chart is irrelevant. Same concepts apply to charts whether they are plotting stock price candles month by month or minute by minute. The science of technical analysis is the theory you read about in many trading books, including this one. So far, we have covered the objective science of how the AVWAP forms and why it is significant to our analysis. Now it is time to address the subjective art of where to start the anchored VWAP to assist in buy and sell decisions. This helps us better manage risk and ultimately make more money. The art of trading is what separates the successful traders from the analysts. Learn the science of technical analysis and raise it to an art form as you implement it with your trades. It is said that you can show a good trader a mediocre setup, and he will make money, and you can show a mediocre trader a great setup, and he will still lose money. Strive to be an objective analyst of the price to AVWAP relationship on multiple timeframes, and you will be an even better trader. Successful traders practice their craft and spend time on layering their experience-based intuition onto their technical analysis. The best long-term performers in any probabilistic field, such as investing, sports team management, and pari-mutuel betting all emphasize process over outcome. Michael Mauboussin anchor to high volume events. The greater the volume of trading at a particular price level, the larger the number of participants with an emotional connection to that price level. Therefore, the price levels around high volume events can be useful levels to set your AVWAP anchor. Unusually high volume, loosely defined as 1.5x normal volume, price events can shock the market and reset the psychology of the crowd. The introduction of new information to a market, whether news events or technical information, can trigger or create a large volume in trading that shakes the market loose from a level of consolidation. This is called a breakout. The breakout creates a sense of urgency as the current valuation is quickly questioned and re-evaluated by many participants. When we set the AVWAP from high volume areas, it helps us to see clearly if buyers or sellers maintain control from the event. Usually large volume at, or associated with, a breakout increases the likelihood of the price trending in the direction, higher or lower of the price from the break. If the AVWAP from the event offers support or resistance, price will typically experience a tradable continuation as price moves away from AVWAP. If instead the AVWAP is undercut and the price remains under AVWAP, the stock is likely to reverse lower. Tests of the AVWAP from a high-volume event will often become a battleground between buyers and sellers, and the emerging trend can set the tone for the stock for days, weeks, and even months. Large price moves, accompanied by a surge in volume, are excellent anchor points because they are where innumerable price memories live. Price action and development of a VWAP starting at these anchor points becomes an objective reference point where we can make an unbiased analysis of price action. From these points, the AVWAP helps us observe the real-time changes in market values caused by the constant push and pull between bulls and bears. Charts 4.1 and 4.2 show bullish and bearish high volume levels as being a good place to set an anchor. Chart 4.1 shows a large volume gap higher 1, and the AVWAP 2 from that level remained important almost 9 months after the initial move began. Chart 4.2 is a chart of a stock in a downtrend, where price accelerated to the downside with the first gap lower 3 and had the heaviest trading volume to that point. The AVWAP from 3 acted as resistance through the months of December and into January. There was another sizable price gap lower in January, which occurred on even heavier volume 4. This is a great example of why not to buy stocks that appear to be down too much. Place anchors at measurable events. In its simplest form, a measurable event is a point where there is a clear shift in the supply and demand dynamics of the stock or market. A measurable event typically involves a larger than normal price move accompanied by a surge in trading volume. As I always say, only price pays, so volume is secondary to the price action. Measurable events occur in 3 different circumstances: fundamental news events, price-based technical events, time-based events. We will explore all 3 categories here to lay the foundation for the strategies in the following chapters. The unique benefit of the AVWAP comes from the ability to start our objective supply and demand measurement from any point that we choose. We don't want to anchor AVWAPs to random points on the chart. The AVWAP is an elegant tool that allows us to measure the combination of price, volume, and time together from any point. The question is, where to set the anchor to help us see the market forces more clearly and ultimately make more money. Anchoring to fundamental events. Fundamental events that may become the catalyst for a large price change could be earnings reports, FDA announcements, Federal Reserve announcements, or any other company's, sectors, or market's impactful report. These may cause a higher volume of trading, but it is important to distinguish between a catalyst such as news and a simple supply and demand shock that might not have been created by a specific news event. It is good practice to know when potential market-moving catalysts, such as earnings report dates, are due in the market. Awareness of these catalysts minimizes the chance we will be surprised by what could be a large price move against our position. It is important to know that a price movement after a fundamental announcement is often counterintuitive. The market is a discounting mechanism, and good news, which was expected, is often welcomed as a profit-taking opportunity by those who had the correct position ahead of the event. Price speaks louder than the opinions of the loudest cheerleaders for the stock, because the post-announcement trading actions of buyers and sellers speak louder than words. Earnings reports. The releases of individual corporate earnings reports are consistently useful anchor points because they are when investors and traders will refine their beliefs and trading strategies about the companies whose stock they are holding or are considering as trade candidates. Corporate results get reported every 3 months. At the end of each calendar quarter, companies prepare their financial documents for the results of the previous 3 months. The earnings reports are then reported to the public. The earnings season refers to the quarterly period where companies report their results. The earnings season begins 1 or 2 weeks after the last month of each quarter: March, June, September, and December, and continues for approximately 6 to 8 weeks. In chart 4.3 below, you can see 3 different anchor points set at the times that the earnings reports were released. Chart 4.3 shows a stock with 3 earnings reports. Each report is a good anchor point for the start of a new AVWAP. Earnings 1 shows how the AVWAP green from the release date held as support on 2 separate occasions. Earnings 2, red AVWAP, shows a negative response to earnings, and then 2 subsequent tests of the AVWAP as shares were sold into the market and provided resistance. Earnings 3, blue AVWAP, shows an acceleration of selling. Notice the steeper slope as sellers reacted to the contents of the report. Notice how the next 4 tests of the AVWAP showed resistance. Other news-related events that can become good anchor points include Federal Reserve meetings and speeches, FDA announcements, activist events around annual meetings, merger and acquisition news and rumors, patent awards, secondary stock offerings, strategic alliances, lawsuits and product recalls, court decisions, new contracts, and supplier issues. Corporate events such as new products, a change in management, dividend announcements, and share buybacks can also be anchor points. I do not mean this list to be all-inclusive, nor is it meant to intimidate you. You do not have to follow all these events to know where to anchor. Best anchor points will become obvious to you as you become more practiced in the everyday application of a VWAP. On the macroeconomic side of the news, a few of the catalysts for price change that might be a good anchor point include economic numbers such as GDP, PPI, CPI, and jobs reports. Other events would include elections, wars, and weather-related events. Chart 4.4 illustrates an AVWAP from a Federal Reserve announcement. Notice how that level became supported several days after the event. Federal Reserve announcement. Chart 4.4 is a major market ETF with the anchor set at 2 p.m., on the day of the Federal Reserve policy announcement. After the initial volatility between 1 and 2, which is normal within FOMC release, the buyers regained control too, and the trend continued higher. 5 days later, the AVWAP from the FOMC release was tested 3 and showed support. We can use this AVWAP level as a place to set stops or to identify new buying opportunities as the stock bounces higher from the AVWAP, price-based events. When price is the news. Price action often is the news, but it doesn't get reported by the media accurately. They try to assign a reason for every move. Price movement is based on supply and demand imbalances as new information comes to and is absorbed by the market. We will briefly look at some of the price-based anchors to consider before we explore them in greater detail in the chapters to follow. Obvious and important highs and lows are easy to recognize after the fact, but that doesn't mean they aren't useful. Highs where prices reversed lower are some of the best anchor points for the AVWAP, as the following tests of that AVWAP often prove to reveal the resistance level. Chart 4.5 shows how an AVWAP from a significant high will often act as resistance for the stock on short-term bounces. When a stock breaks downward from a previous uptrend, an anchor to the most recent high is one of the best places to set an anchor. The anchor would probably not be set until somewhere in mid-November 1, as that is when it became clear the early November high was an important one. While the stock is below the AVWAP from that high, consider it guilty until proven innocent. Notice how the upward rallies during the long period of declining AVWAP that started at the anchor point found resistance during multiple tests over the next 3 months too. On balance, buyers of the stock on the short-term rallies are losing money and short sellers have control. An important low is also easy to recognize after the fact. Even if it takes a couple of days for the low to become obvious, it makes sense to monitor to see if buyers defend the average price from that low. Chart 4.6 shows how an AVWAP from a significant low will often act as support for the stock on pullbacks. When the stock makes an important low, we will recognize it a few days after the fact, and then anchor our AVWAP from that now identified low, 0. Value and direction of the AVWAP might not be clear for days to weeks later until after it is tested, and in this case provides support too for the stock. When the stock is above the rising AVWAP, consider it innocent until proven guilty. This means buyers are in control and sellers are fighting a losing game, anchoring to specific time-based events. A third category of places to which to anchor the VWAP is time-based. Many decisions of portfolio managers are based on time increments, daily, week-to-date, month-to-date, or even year-to-date. People often say that institutions only use VWAP for one day in their trade executions. That is simply not true. As we learned in Part 1, Chapter 3 institutions may set buy or sell programs for as short as a couple of hours. It is also common for institutions to use AVWAP programs to buy or sell individual stocks, or to buy or sell broad-based markets, and to execute one large order for periods such as a calendar week, month, quarter, or even year, for very large orders. Bottom line is that institutions have strategies and timeframes that are as varied as the techniques used by individuals. Why wouldn't they? Below, we will look at some examples of broad market ETFs and individual stocks, where there is clear evidence on the chart that buy and sell programs are time-based. Week-to-date, WTD. Swing traders should keep an AVWAP that begins at the start of each week on their charts. We will see how often it comes into play as support or resistance as the week progresses. The week-to-date AVWAP 1 in Chart 4.7, page 91, is when I start each Monday morning on all my charts. The WTD AVWAP will act as support 2 and resistance 3, and on the chart, those roles on all timeframes can and often do reverse. Month-to-date MTD. When you start an AVWAP at the beginning of the month, it might not show its value until a week or two later. Once you have a MTD AVWAP on your chart, as seen in Chart 4.8, you will see how often it does become support or resistance. 1 month of trades is shown in chart 4.8. The anchor is set to the start of the month and builds from there. Some institutions may decide to purchase a stock over the course of a month, and their programs purchase as many shares as they can at fair value for the month on pullbacks to the AVWAP 1. Notice the black arrow 2. The stock opened well below the AVWAP that day, but immediately reversed higher. It is always best to set your stop-loss orders after the market is open. Doing so will save you from throwing your stocks away on a manipulated lower open in search of stop orders. The first few minutes of the trade day can be more volatile as deep-pocketed participants hunt for stop orders. To avoid the initial volatility, I generally use the low of the first 5 minutes of a new day as the new stop if the previous stop was traded through on a gap lower. Order to date, QTD. Some institutions, pensions, and mutual funds will make the decision to buy or sell a large position in a stock over the period of a calendar quarter. These decisions are often based around earnings reports. Chart 4.9 shows the price action for 1 calendar quarter. Notice how the AVWAP from the first day of the quarter 1 acted as support on pullbacks 2. Some institutions make quarterly decisions to execute massive orders that need time to be filled. Always be aware of the slope of the AVWAP as prices approach and test it. The steeper the angle of the AVWAP, the greater the evidence that buyers are more active than sellers, and the more likely it is that the AVWAP provides support. Thus, it is more likely that stock will bounce higher after an AVWAP touch. Year to date, it's important to understand how some institutional portfolio managers use YTD AVWAP. In short, it is part of how they are paid. Fund managers are paid based not only on the absolute performance of their funds, but also on how they perform relative to a benchmark index or relative to the performance of their portfolio. As an example, a manager who runs a semiconductor fund will want to make sure his average cost for the semiconductor stocks his fund owns is at least as good as the AVWAP from the first of the year. If the fund manager buys stocks above the YTD AVWAP, it will hurt the performance of the fund on a relative basis, and as a result, he will be paid less. If instead, he is able to purchase the stocks in the portfolio at a price less than the YTD AVWAP, that fund will likely outperform others, and he will earn more. For stocks in strong uptrends, the YTD AVWAP will often act as support as fund managers purchase shares at this fair value of the stock for the year. Conversely, when the stock is in a downtrend, fund managers will use rallies up to the YTD AVWAP to lighten up on their positions while the stock is closer to fair value. Chart 4.10 shows AVWAPs from the start of 2 different years. The start of a new year, 1 and 2, is a level that institutions will measure risk against, both in the markets and in their individual stocks. What is often surprising is the AVWAP from the previous year, 1, will still take on significance as a level of support or resistance well into the next year. Anchored VWAP handoff and pinch. Handoff. When price speeds up from the original anchor point, we can set a new additional anchor to help define the stronger momentum. This concept is introduced in chart 4.11. Blue AVWAP anchored to the low point shows an uptrend. Stocks can find renewed interest and accelerate dramatically from such an existing trend. When this occurs, we can set a new AVWAP to help identify this strength. The new purple AVWAP 1 can help with new entries and stop placement in open positions. The place we anchor the new AVWAP 1 is the handoff area. It can also be referred to as a new layer of momentum, pinch. When we have identified key swing high and key swing low levels and the stock coils between those 2 AVWAPs, they pinch together. The pinch is a compression of energy, that is, the aggregate of traders' reevaluation of strategies and their plans to buy or sell as soon as the price breaks one way or the other. When the stock exits the pinch, it is often an excellent trade in the break's direction. Chart 4.12 is an example of an AVWAP pinch. In chart 4.12, the stock is compressed between the 2 AVWAPs as energy builds. The red AVWAP from the swing high 1 represents the dominant trend because it is longer term. The green AVWAP 2 starts at the swing low. As the stock ping-ponged between the 2 AVWAPs, energy was compressed until the stock broke the AVWAP support represented by the black circle 3. This was an excellent place to short the stock. A stop for this trade might have been placed above the resistance at the red AVWAP, where the 3 red arrows 4 came together. Going deeper, anchor to price gaps. In chart 4.13, a gap shows up on the chart when there is a large imbalance between supply and demand on the open, and the market must open well above or below the prior day close to find liquidity to fill the opening order. This leaves a gap or area where no trades appear on the chart. These gaps reveal a strong shift in sentiment and become excellent anchor points to measure subsequent action from. This is so important that I wrote Chapter 9, a VWAP gap trading, to thoroughly explain it. Chart 4.13 is one example of an AVWAP from a gap to familiarize the concept before we study it in greater detail. Chart 4.13 shows the anchor set to the gap in price action. This is the circled area where the first candle opens higher than the prior day's close. Notice, the first test of the gap, AVWAP 1, is not quite perfect support, but tests 2, 3, 4, and 5 find buyers almost exactly at the AVWAP from the gap. Notice price action at points 3-5, where the AVWAP is repeatedly tested with very little bounce in the price. This is a clue that the stock may be weak. For various reasons, participants may collectively lose interest in buying, and you should raise stops to just below the low 2 to ensure you book profits before a larger sell-off comes. Market psychology, the art of anchoring. The art of anchor placement is something that makes more sense as you experiment with using the AVWAP in your daily analysis. It is easy to fall into the trap of curve fitting an AVWAP to justify a level you want to believe is support or resistance. Technical analysis is the study of price action, but more importantly, it is the study of the motivations of other participants and where they make decisions to buy and sell. Because the market has memory, we want to know the levels that are most likely to have the highest emotional attachment for other traders and then measure how price action develops around those levels. These levels are often driven by fundamental catalysts, but they can also be purely price-driven. Risk management. The fear of missing out, FOMO, can ruin the best-laid plans for a trade. Learn to anticipate the trade setup and then wait for price confirmation before you participate in the trade. One technique I use to combat FOMO entries is to set alerts ahead of a potential buy or sell level. Rather than set a buy stop, the alert simply tells me to take a closer look at the stock as it approaches the key level. When the alert is triggered, I will watch the stock more carefully and decide whether it is time to take action or if the stock needs more time. If I decide the stock still needs more time for a new position, I will set a new alert and repeat the process until I decide to enter a trade. This method allows me to become familiar with the short-term action in the stock and to fine-tune any adjustments to my plan, including where to set my stop. Key takeaways. Some of the most important levels to anchor the AVWAP to include fundamental news events, price-based technical events, news events such as earnings reports, Federal Reserve announcements, jobs reports, and other institutional publications or press releases, time-based events. AVWAP techniques build on each other and strategies can be formed based upon patterns or situations such as the AVWAP handoff and AVWAP pinch. Time-based AVWAP anchors include traditional daily VWAP as well as week-to-date, month-to-date, quarter-to-date, and year-to-date. Price gaps occur from a sudden shift in perception of value of the stock, and those levels become important anchor points. Chapter 5, the AVWAP pinch. Energy and persistence conquer all things. Benjamin Franklin. Chapter objectives. 1. Recognize a pinch as it forms. 2. Recognize when to get involved in a pinch. 3. Recognize who is in control of a pinch. 4. Understand why a pinch is not a reason to buy or short a stock. 5. How to manage risk when a stock breaks free of a tight pinch. Stocks that move out of a pinch can offer some of the lowest risk, highest probability trend continuation trades. Learn to recognize how this AVWAP strategy forms and how to trade it effectively for larger profits. Markets are not one-dimensional. There are trends within trends. When a longer-term trend begins to pull back, it forms a short-term downtrend within the longer-term uptrend. An AVWAP pinch refers to a compression of energy from buyers and sellers for a stock or broad-based market as the range tightens between two different AVWAPs. The original AVWAP acts as support or resistance from the longer-term, more powerful trend. The newer AVWAP contains price action from the counter-trend corrective move within the larger time frame. Look for high-probability trades when the shorter-term trend comes into alignment with the longer time frame trend. The emergence of an AVWAP pinch is often the start of that alignment. Market movement occurs with a price and volume expansion and contraction, often alternating. The AVWAP pinch forms when the battle for control creates a compression of energy, represented by a tighter trade range. Eventually, the range breaks, and the buyers or sellers take control of the trend to create a new momentum campaign. While the stock is in the pinch, it is just a setup, not a reason to buy or sell. We should not take action until it breaks out of the consolidation area by making a higher high long or a lower low short. Chart 5.1 shows how the pinch forms between a longer and shorter term AVWAP. In Chart 5.1, we recognize the anchor 1 as a significant low only after the stock has built momentum from that level 2. As the stock progressed higher, it didn't break to a lower low until 4. At that point, we know to set an anchor to the highest high 3. And the stock began to pinch, that is staying at a price between the AVWAP starting 1 and the AVWAP starting 3. When the stock breaks out of the pinch 6, it can be purchased with a stop below the most recent and relevant higher low near 5. How the pinch forms. While the stock is in a pinch, it is a battle between buyers and sellers. As the range narrows, it shows a constriction of energy, and the stock comes closer to a state of equilibrium. The dynamic support and resistance ranges formed by the converging AVWAPs show the interplay of the larger timeframe trend and the shorter-term counter-trend movement correction. Think of the pinch like squeezing a spring together. The energy gets compressed until the spring is let go, and an energetic move follows. Trading volume and price range tend to contract simultaneously during a counter-trend move, i.e., a pullback in an uptrend or short-lived rally in a primary downtrend. This action shows a lack of near-term certainty by buyers and sellers. There is no advantage to be involved in the stock as this battle continues, and the stock is in the pinch. Instead, we want to watch the stock for the re-emergence of the primary trend so we can participate as the short-term trend comes into alignment with the longer, more powerful trend. While the stock is in the narrow range of a pinch, we want to prepare our trade and think through the scenarios of how the trade might work out. This process is where we develop our risk/reward scenarios. We set alerts on our trade software, so we know the moment price begins to move. Large moves often emerge from a pinch as many participants are not alert to the quick price changes, so they end up chasing the momentum. As we discussed in Part 1, Chapter 2, stocks alternate between periods of price range compression and price range expansion. We want to identify where the range compresses prior to the next momentum campaign so that we can anticipate the breakout of that range. When we buy the stock as close as we can to the emergence of a new trend, we maximize gains and minimize our risk. When trends come into alignment, they present us with low-risk, high-probability trades. How we participate as a stock breaks from a pinch is illustrated, along with the appropriate stop placement, in Chart 5.2. The stock in Chart 5.2 experienced a strong run from 1 and began to pull back 3, so we set a new AVWAP in red back 2. The stock then pinched between the green AVWAP that started 1 and the red AVWAP that started 2. At 5, the stock made a higher high above the red AVWAP from the peak 2, so it made sense to purchase the stock with a protective stop loss below 6 to assure that we take only a small loss if the stock reverses lower. Notice how the stock didn't immediately find the higher momentum. If the stock does not violate the initial stop, in this case at 6, give the stock the opportunity to work. As the stock made a new high 7, we raised the stop to 8 because it is a higher low after the higher high. With each new high, we raise the stop to under each new higher low. In Chart 5.2, we raised the stop to the new higher low 10 when the stock made another new high 9. When to get involved. The ideal time to buy a stock is as it breaks free of a tight range. The early entry to an emergent trend gives us 2 advantages. 1, we become involved just as the trend begins, so we have the greatest profit potential. 2, if the breakout cannot hold, we can place our stop close by. For long positions, we place our stops below the most recent and relevant higher low, and for short sales, we place our stops above the most recent lower high. The simple definition of trend tells us there is more opportunity when we buy stocks in uptrends and short the stocks in downtrends. All too often, I see traders fight this common sense approach and attempt to purchase stocks in downtrends. They are irrationally anchored to a previous price level and view it as a bargain while prices decline. Or they try to short stocks which appear to be up too much, rather than embrace the higher probability and lower stress profits that come from an approach that follows the trend. The tighter the stop we have, the greater share size we can trade while keeping our R multiple a constant. Eventually, one side will take control of the trend. It is most likely that the direction of the AVWAP of the longer time frame will resume its trend, because once a trend is established, it is more likely to continue than to reverse. When price comes out of the contraction found in a pinch, it shows whether the buyers or the sellers from the longer time frame AVWAP are in control, and whether it is reasonable to expect that a sustainable trend move has begun. Longer time frame participants become emboldened by their profitable positions and are likely to defend the trend. The shorter time frame participants who bet on the less powerful shorter-term trend feel trapped. When feeling trapped, they may exit their losing positions or even flip from short seller to buyer or buyer to short seller. All of this makes a continuation of the longer time frame trend more likely. In contrast, Chart 5.3 shows a pinch with a reversal of the longer-term trend. This stock pinched between red AVWAP that began 1 and the green AVWAP that began 2. As it made a higher high above the red AVWAP 3, it was time to purchase the stock with a stop 4. When the stock makes another higher high 5, we raise the stop to 6. The stock then made a large surge 7. A strong move like this is often an excellent opportunity to sell part of the stock and then raise the stop on the balance to the higher low 8. In Chart 5.3, we see 9 that the shorter-term green AVWAP crosses up through the longer-term red AVWAP, which was from the initial anchor point at the then high 1. Some traders believe an AVWAP cross is useful, but I've noticed no significant trade advantage in them. Chart 5.4 shows us why we do not get involved until the actual break of the pinch occurs. AVWAP pinch is typically not always resolved in the direction of the primary trend. Not all pinches will resolve in the direction of the longer, more powerful trend. The stock in Chart 5.4 pinched 3 between the AVWAP's anchor points green at 1 and red at 2. Because we know a trend once established is more likely to continue with the primary trend, we would have expected an upside move beyond the red AVWAP 2. Instead, the stock broke a lower low 4 and then experienced a large and fast move lower. This type of move shows why it is important to wait for price confirmation to break higher before we buy. If you purchased before the upward momentum was established, you would have seen a large and unnecessary loss. Some traders might think the failure of the upside break was an opportunity for a short sale. Remember, this book is not about counter-trend trades or fading the trend. We are focused on trend-based trades, which is the higher probability of success way to trade. Readers are encouraged to use the information in this book to enhance their favorite trade strategies, whatever they may be. Market psychology, recognize who has control. You may be familiar with names of patterns such as head and shoulders, triangles, flags, pennants, and cup and handle. These patterns represent a contraction of price range, which then typically leads to a continuation of the price trend. We can also apply the concepts we learned about the AVWAP pinch to those patterns on all time frames. The compression of range simply represents the tug of war between buyers and sellers as they wrestle for control of the trend. The emergence of a new trend out of this compression shows which side has gained control, buyers or sellers, and it becomes their game to lose. We can never fully trust that the buyers or sellers will maintain control once the new trend emerges, which is why risk management is always job number 1. If a move does not continue in the anticipated direction, we want to place our stop to ensure that any exit minimizes the risk of a large capital loss. When the stock does move in the expected direction, our job becomes risk management for the open position. Winners do not take care of themselves. Chart 5.5 shows an inverted head and shoulders pattern, which is further defined by the AVWAP pinch. If you are familiar with the classic chart pattern, the head and shoulders, Chart 5.5 shows how the AVWAP adds further clarity to an inverted head and shoulders pattern. For simplicity, I've labeled left shoulder LS, head H, and right shoulder RS. Once the stock broke below $54 per share, 2, we knew to set an anchor to the recent high 1. Then the stock formed the inverted head and shoulders pattern. The AVWAP from the peak 1 then acted as resistance at points 3, where buyers tested the price. As the right shoulder made a higher low, we then anchored a new AVWAP green back at the candle at the bottom of the head. At 4, the stock made a higher high. This is where the stock could be bought with a stop just below the most recent and relevant higher low, 5. In charts 5.6 and 5.7, we see an example of a stock in a longer-term uptrend that broke out of the pinch in the opposite direction of the primary trend. It is important to always wait for price confirmation before you put your hard-earned money at risk while the stock is in a pinch. The stock in chart 5.6 showed two important anchor points with large gaps on the day the company reported earnings. At the first earnings report, AVWAP 1 didn't show its significance as support until after the second AVWAP 2 was set. In late December and early January, the first AVWAP green showed repeated support green arrows for the stock. The AVWAP from the second earnings report red showed strong resistance red arrows, and it resulted in the stock getting pinched. We would monitor this stock for a potential upside break. Chart 5.7 shows that a break in the direction is not assured. Point 3 shows how the price broke lower than the longer upward trend, the first AVWAP in green. Chart 5.7 uses the same stock as chart 5.6. This time, we see the result of trading after a third earnings report 3 was issued. This was a genuine surprise to the market, as the stock failed miserably after that report. Notice how the stock continued lower for the next month after the earnings report 4. There are 3 lessons here. 1. Do not purchase a stock while it is in the trendless period of a pinch. 2. New purchases of a stock before earnings releases can be perilous. 3. There is no rush to buy stocks that might appear to be a value after a large sell-off. Market psychology. How committed are buyers and sellers? If prices move quickly and have larger than normal volume levels, it can show us there may be traders and investors from different timeframes competing for the available supply, upside breaks. This behavior is known as a range break. An opportunity to buy after a pullback might not present itself for several days. The speed of a range break can reveal how motivated one side is and may change your entry technique. This can be especially true of stocks that break out when they are accompanied by a fundamental event, such as an earnings report. The stock in chart 5.8 came out of its pinch with a small gap, 7. As always, the concepts and setups discussed occur in all time frames. Chart 5.8 is constructed of 1-minute candles for the first 50 minutes of this day. Anchor 1 occurred at the start of the day after the stock gapped significantly higher from the previous day close. Initially, buyers held control of the stock, but then it broke below the daily VWAP red 2. A day trader could start a short position with a stop above the high of the day 3. After the initial bounce, the stock found resistance at the daily VWAP 4 and 5, and stops could be lowered to just above these short-term peaks. A new AVWAP green was anchored to the new lower low 6. The selling sped up 7 as the stock gapped below the AVWAP from 6. Longer-term traders may look at this and not see the value of trading on a 1-minute chart, but shorter-term traders could have the opportunity to profit from more than a 2-point decline in less than an hour. The anchored VWAP pinch is a setup that typically gives us plenty of time to anticipate the trade setup as the stock ping-pongs between the two significant AVWAP levels. You may be tempted to enter the stock before it exits the pinch and makes a higher high longs or lower low shorts, but as we saw with the preceding examples, an AVWAP pinch is not a reason to buy or short the stock. We should enter the trade when the stock breaks out of the pinch to participate in the emergent momentum. Of course, no trade plan is complete without setting a stop after the entry to protect against catastrophic losses. Risk management. Trends are not one-dimensional. There are trends within trends, and therefore we wait for price confirmation before getting involved. An AVWAP pinch is most likely to break in the direction of the primary trend. The tighter the pinch, the more likely it is to experience a powerful break. When a stock breaks free of a tight pinch, we can keep close stops and trade more shares with the same R multiple at risk. Key takeaways. An AVWAP pinch is a tightening of the price range. The break of the pinch often leads to excellent trend trades. The action point of an AVWAP pinch is when it breaks free of its consolidation. The ideal time to buy a stock is as it breaks free of a tight range. The early entry to an emergent trend gives us 2 advantages. 1. We become involved just as the trend begins, so we have the greatest profit potential. 2. If the breakout cannot hold, we can place our stop close by. It is more important to understand the psychology of how a pinch is formed than it is to simply recognize pattern formations. Not all pinches will be resolved in the direction of the primary trend, which is why we wait for price to confirm the break before we get involved. AVWAP pinches are formed and are actionable on all time frames.